What started out as just a relief rally is starting to become something real.
Institutional risk sentiment has improved so much that people are willing to put money to work.
The risk in stocks are a little higher today than they were in April.
All the negative things which could happen have dissipated, at least for the time being.
It doesn't really make sense for equities to be hitting new record highs. I think that is a pain trade.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, the policy volatility continues. Senate Republicans pulling an all-nighter, looking for votes on a major tax bill, as President Donald Trump faces off with Elon Musk over EV subsidies, and the European Union is preparing to accept a universal 10% tariff. It's goodbye Q2. Hello Q3. It's a new quarter. It's the same story.
It's the same story of policy uncertainty that seems to be the presiding sentiment and the presiding theme over 2025. We will get clarity in 2 weeks. That is always what happens. Maybe it's going to be 2 months. The real question that I have is, how much have the changes in valuations reset the game? And I'm talking about the dollar that just had its worst half since 1973. I'm talking about stocks that continue to grind higher with people still saying the pain trade is up, given the fact that this policy uncertainty has still not fully been priced in or internalized.
The President of the United States taking on Elon Musk, taking on Chairman Powell, and taking on Republican holdouts staying up all night in the Senate.
There's a number of holdouts right now, and this is what you see Senate Majority Leader John Thune basically going in and out of his office with different individuals, trying to see if he can get them to yes. This is a long slog. He continues to say we're close, but he's been saying we're close for the past 5 hours or so, so we're not just that close yet. There's two people I'm watching. One, Senator Ron Paul. Everyone thinks that he's a no, but potentially, if they bring the debt ceiling money down to lift the debt ceiling from $5 trillion to something more like $500 billion, he might be able to go for a yes. And then Senator Murkowski from Alaska, she wants to see a carve out for her state when it comes to Medicaid. If they're able to get acceptable language for the parliamentarian and get a yes on that, she could be a yes to the final bill. He needs one of these two, and these are the two I'm watching this morning.
Tyler Kendall down in Capitol Hill. Tyler's going to join us in just a moment. Also monitoring what's happening in foreign exchange. Lisa talked about the weakness on the US dollar. Need to talk about the strength for the euro. Euro dollar 118.15, and earlier on this morning, waking up to just a little bit of pushback from the ECB.
Saying that if the level gets above 120, that becomes a problem. Below that, it's okay. Well, we're getting toward that. We've had 8 straight sessions of strengthening of the euro versus the dollar. If today is the 9th, that is going to be the longest streak going back to 2004. Luis de Guindos was the one who came out and really pushed back against this. At the same time, it potentially lowers their inflation. It just also lowers the impulse to tour over to Europe. So I wonder how much this is a tourism issue rather than simply just a currency appreciation.
And exports and trade and all of that, and the disinflation rate. We'll get into it later. Euro dollar 118.13. That's the price action of this morning. Coming up this hour, we'll catch up with Julian, Emanuel of Evercore as stocks post the best quarter in more than a year. We'll speak to the former NEC Deputy Director Everett Eissenstat as the White House says trade deals are looming, and Erik Nelson of Wells Fargo on the dollar's weakest start to the year in half a century. We begin this hour with our top story. An all-night voting session underway on Capitol Hill as the Senate debates President Trump's tax bill. Joining us now is Tyler Kendall from Washington with the latest. Good morning, Tyler.
Yeah, hey, John, good morning to you, but probably not a good morning if you are a U.S. Senator, because they have been in the middle of this vote-a-rama since 9 a.m. Eastern yesterday, because Senate Majority Leader John Thune still does not have the votes to pass this package. And importantly, at the moment, he's trying to work out some of these key deals to get Republicans on board, because they are broadly aligned when it comes to the key pillars of this package, like the tax cuts, but they remain really divided when it comes to those spending cuts. And we're still watching the same 8 holdout Republicans that we've been discussing for really the past few weeks, and they haven't seemed to give any indication that they are going to budge. There are 2 threads that we're watching here in Washington that I'd point you to that could kind of tell us where this morning could be headed. One is that we're seeing the White House really ramp up the pressure here. An administration official tells us that President Trump is in constant contact with lawmakers on the Hill. We're trying to track down exactly which lawmakers he's calling and what sort of deals deals the White House could be offering to get their votes over the finish line. The second I'd point you to is that there's still two key amendments that senators have yet to vote on that could change the trajectory of this legislation. One is an amendment that would roll back the expansion of Medicaid under the Affordable Care Act. It's likely not to pass, but that is considered to be a win for fiscal hawks that were pushing for this to come up to debate. A second amendment, though, does appear to be on track with some more momentum behind it because it has Democratic support, and that would be a more lenient timeline for the phase out of some of those clean energy tax credits, including solar and wind. John, that really could be one of the pivotal pieces in this puzzle to get enough moderates on board for John Thune to get it over the finish line.
Tyler, we need to talk about Elon Musk as well. They're stuck between a rock and a hard place. They've got a decision to make. Do they choose to upset one of the biggest donors to their party, or do they choose to upset the President of the United States?
One of the biggest donors to the party, exactly. He gave more than $290 million during the 2024 cycle, not just to the White House, but also to those down ballot races. And we're really starting to see the money pour in already. Take Thomas Massie, for example, a Republican from Kentucky who is a hard no on this bill on the House side. President Trump has already created a super PAC to primary him in Kentucky, really making good on his threat to put up a challenge ahead of that race. But then we got confirmation from Elon Musk yesterday that he has poured money into the race in favor of Thomas Massie. So they really are on a collision path at this point. But if they do go against President Trump, perhaps Elon Musk could be there to give some extra funds.
Tyler Kendall with the latest in Washington. Tyler, stay close. More from Tyler through the hour. As the voting continues in Washington, D.C., tracking the latest move in Tesla in the pre-market down by 4.5%. Here's the view on Wall Street this morning. Julian Emanuel of Evercore saying it's not yet the time to pile in, writing the following: a pullback is our base case, given the parabolic move already and the risks from tariffs and policy to the economy. Julian joins us now for more. Julian, good morning.
Good morning.
Should we take a beat? How's it feel, the last quarter? What was that like for you?
Look, incredible. In many respects, though, the market actually did what it was supposed to do, okay? You had this incredible surprise reaction to something where we were completely not used to what we were seeing, which was a tariff schedule, higher than Smoot-Hawley. And then you got what you actually didn't get at the bottom in October of 2022, a volatility event, an actual capitulation that really presented the buying opportunity very, very clearly. And from our point of view, the surprise is the unrelenting speed with which the market continues the advance.
Massive move, 20% plus off the lows on the S&P, 30%, something like that on the NASDAQ 100. I sit here and I wonder, looking out 12 months now, can you say with confidence the outlook for earnings is getting better or worse at this point?
It's definitely getting better, okay? Because basically what has happened is you've had this adjustment from tariffs, and now that there is this presumption that you are going to get, and we can talk about the effect on interest rates later or what have you, that you're going to get some form of stimulus that is going to be more favorable to the 2026 picture. Obviously, the 2025 picture remains in flux, and we're going to find that out in a couple of weeks when earnings season starts. But in general, the whole narrative of the economy having avoided a recession is a reasonably positive backdrop.
Let's put the one big beautiful bill on the side for 1 second and just go to the tariffs, which you mentioned are still at the highest going back to the 1930s and haven't fully been priced in yet when it comes to whether it's consumer prices, whether it's companies absorbing it in the profit margins. What makes you think this isn't going to show up in earnings in a material hit to profit margins for a significant number of companies?
Well, so the work that we've done was the expectation that roughly it'd be a 50-50 split. Larger companies will shoulder less, smaller companies will shoulder more of the tariff hit. And yes, it definitely will fall into earnings. But again, there is this presumption that it is the one-time hit and that there will be this transition period, which obviously for the market began in the spring. But we're already sort of pricing through that. And again, what it points to is the resilience of corporate America, the ability to adapt, the ability to move supply chains, and the ability to figure out what a correct pricing strategy is.
Are we putting an economic narrative to a market story? To something that really is big tech names that continue to innovate in a technological boom that is trickling out into other companies at the same time that there are these independent factors that are very real that are affecting other asset classes. And we talked about the dollar. That might be where some of the vigilantes are going, or this question of where the marginal buyer is going to be, how the market responds to negative news in the economy. How much are we making an economic argument for something that is now increasingly divorced from the economy?
Well, again, stepping back, the story of this year, and in large part from our point of view, the reason that the advance off the April bottom has been as unrelenting as it's been is because we are now finding that corporate America is understanding how to use AI constructively across all industries, not just for cost saves, but for revenue enhancement as well. And this is something that we think is going to continue to proliferate. And when you think about it, is part of the reason, look, we're uncomfortable with where multiples are, which is why we think that you're likely to have a pullback. But on balance, it is something that supports, higher multiples ex ante than what we've seen.
A pullback when, though? Because you talk about a FOMO-driven melt-up. What if you missed that?
So, look, it could be going on right now. But from our point of view, there's enough policy uncertainty out there that I would equate this more to the sort of FOMO that we had in and around the election. Remember, a lot of froth there, led by crypto names, led by names that were tied into the Trump administration. And I think we're seeing a lot of the same thing now. But again, the actual activity supporting a more prolonged period of FOMO hasn't materialized yet. We do think you need to get, less policy uncertainty to get to that period.
What uncertainty unnerves you the most? Lisa mentioned tariffs. Right now we have this debate on the one big beautiful bill, but no one thinks it's not going to pass. It just might be an absolute slog, and it's probably not going to come on July 4th. What's the uncertainty that makes you nervous to really want to add more to your exposure?
So I think it's what the response is going to be in and around July the 9th. That's the tariff story. But again, this other idea that we're seeing the resilience on the corporate earnings front. But if you go back to last Friday, it was really the first indication, with the inflation numbers higher than expected and the income and spending numbers weaker than expected, GDP revised down, that yes, in fact, this theorized pass-through from tariffs might actually, in fact, be hitting.
What's the best outcome for July 9th? Asked this question yesterday. Is it extend and pretend, keep negotiating, or 10% and move on? What's the best outcome for you?
I think you'd like certainty. I mean, if you just went to 10 and said that's it, that would be fine. The market would embrace that. But something leads me to believe that it isn't quite going to be that simple in negotiations.
You're not alone, by the way, and I think this is interesting that the market is just sort of happy, and I think was happy several months ago with the idea of a 10% universal tariff. Move on to other things.
Then companies can actually price it in. They can rearrange the supply chains. And like Julian said, the adapt and adjust, which you see in so many different companies, is what we've already seen with respect to half being absorbed by them, a little being absorbed by them, and maybe just a small marginal one-time price increase.
And to your point, Jonathan, the market was happy. I was there. It was rallying when the president got up in the Rose Garden and said, here's a 10% across-the-board tariff. It only started to crater when they came out with the massive billboard of the reciprocal tariff rates that were extortion for some countries.
Anchored us all to the extreme, and now we're happy with 10%. And apparently even the EU is now happy with a 10% universal tariff.
With carve-outs, in fairness.
I mean, sure, whatever.
But that's not what we're going to get, because we also have sectoral tariffs, and you've got countries that are waiting for the 232 investigations to continue.
These countries aren't arguing about the 10% universal tariff. They're not even debating it with the US at all.
Which goes to the question of, if you anchor to the extreme, Is that the way to get people to all accept something that would have been extreme?
It's a massive U-turn to when I was in the Netherlands last week, and they said they would not accept a 10% across-the-board tariff. Now, a week later, okay, fine, we'll accept 10%, but we need some help on steel and autos.
Ollie Crook's going to join us a little bit later in the programme to get you the latest from Europe. Big changes on the trade front still expected. Equity futures at the moment down by 0.2% on the S&P, with an update on stories elsewhere. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Senate Republican leaders continue scrambling for votes to pass President Trump's $3.3 trillion tax and spending bill. They've been up all night, and as you can see in the live picture behind me, are continuing to vote on amendments to the legislation amid deep party divisions over clean energy and Medicaid cuts. 8 Republicans are holding out their votes on the bill. Meanwhile, the European Union is willing to accept President Trump's 10% universal tariff, as you guys were just talking about. Sources telling us here at Bloomberg, the EU wants the U.S. to commit to lower rates on key sectors such as pharmaceuticals, alcohol, semiconductors, and commercial aircraft. The bloc has until July 9th to reach a deal before tariffs on nearly all of its exports to the U.S. jump to 50%. And President Trump is continuing to attack Fed Chair Jay Powell, posting on Truth Social yesterday, Jerome Tule Powell and his entire board should be ashamed of themselves for allowing this to happen to the U.S. If they were doing their job properly, our country would be saving trillions of dollars in interest costs. He says we should be paying 1% interest. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on in the hour. Handwritten note with all the interest rates around the world. And the United States at the wrong end of it for him.
So just to go back to your point, is this anchoring to the extreme? Like, forget 1 point.
We'll take
2
3.
We'll take 3. Maybe if we get 2, it's okay, But, let's start with 1% interest rates.
Julian's going to stick with us. We'll have more on fixed income and interest rates and what it means for the equity market in just a moment. Up next on the programme, the Vote-a-Rama continues.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. We're all on the same page on how to grow the economy while controlling and bringing down expenses.
Live from New York City this morning, good morning to you all. Equity futures negative on the S&P following back-to-back all-time highs. Later on this morning, 9:30 Eastern Time, a must-watch panel. Check this out. ECB President Christine Lagarde, the Chairman of the Federal Reserve, Jay Powell, the BOJ Governor, and a whole lot more coming to you live from Sintra, Portugal. The world's biggest central bankers, the biggest names on the planet in finance, their views on interest rates and what's happening with this economy following the policy shock of the last few months. In the markets right now, market couldn't care less. Equity futures just a little lower, down 0.2%. All-time highs on the S&P at the close of yesterday's session. At the close of Q2, coming into Q3 on a 3-day winning streak. In the bond market, yields down last month, down on the quarter. On 2s, on 10s, on the 10-year right now, 4.1949. We're down another 3 basis points, even with the focus on Washington, D.C. and a big tax bill just moments away. Under surveillance this morning, the Vote-a-Rama continues.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like. We're all on the same page on how to grow the economy while controlling and bringing down expenses.
It's the latest this morning. Senate Republicans pulling an all-nighter, looking for votes on the big, beautiful bill. In the bond market, no change in the face of all of this. Julian Emanuel of Evercore joins us now for more. Julian, let's continue this conversation. We aren't seeing the pushback from fixed income. We aren't seeing the high yields that so many people anticipate. And in fact, yields are starting to break the other way. What's the relationship between your outlook for the equity market and what's been happening in fixed income?
No, it is definitely a mystery. There's no question about it. And it almost makes you wonder as if there might be a time where, let's say this bill passes and then we wake up and yields start moving higher by, a reasonably significant amount. But at the end of the day, if you look at it, the yields have been going sideways for 2 years, okay? Literally somewhere between 4 and 4.5 for 2 whole years. And frankly, that's perfectly fine for the equity market because, again, that removes part of the uncertainty.
Well, okay, they've stayed the same, but the backdrop has been very different economically. People went from a very high benchmark interest rate understanding of the world that was high inflation to one that now, if you put all of the other potential tariffs and other disruptions out of the picture, we would be looking at pretty much close to 2% inflation rate. We're looking at basically mission accomplished. So is this highlighting a new premium that will ultimately challenge U.S. valuations and risk markets in a way that has not fully been appreciated?
Well, there's certainly an element to that. However, the countervail to that is that we are likely to get a new Fed chairman sometime next year that is going to be, let's say, a little bit more accommodating in terms of bringing interest rates down.
Let's say that they're accommodating and taking Sharpie messages of the world's interest rates and saying, OK, we'll cut 3 percentage points in this meeting, regardless of what happens. What happens to the long end in that situation?
You will get a yield curve steepening, the likes of which most investors do not remember that 20 years ago and so on, 2s, 10s was more in the neighborhood of 150 over rather than 50 over, a very rapid steepening. And frankly, when we think about what the risks to the equity market are, 10-year yields going through 5%, far and away at this point, are the most significant risk.
When can that happen?
Again, the psychology right now is telling you it doesn't seem likely. Because as John pointed out, counter to expectations, in really the same way the dollar weakness is counter to the expectations of people that thought tariffs would be bullish to the dollar. It really just takes a turnaround in psychology that we don't see. But I would suggest that if the inflation data continues to firm, at the same time, we get more sort of pushback on the direction of tariffs. That's the mix that sends
the dollar move,
higher.
I think, Julian, speaks to exactly the risks you describe. Just go through the scenario. You face a situation where you do get a Fed chair that's, let's say, is more willing to drop interest rates regardless of what's happening elsewhere. You get the curve steepening you describe. You get all the debt issued at the front end with the Federal Reserve cutting interest rates. Then that's precisely one of the reasons you're seeing the dollar strength that's been developing, Lisa, over the last several months.
What is the fear that this is going to be a Fed that's going to try to monetize the debt, that's going to try to essentially print money to offset this by having rates at a very low level and then just printing money at that level? And how much does it take at this point to create dollar strength, given that that fear has been embedded in the overall investor base?
Isn't the president actually arguing for that right now?
Yes.
Over the last several months?
100%.
Almost explicitly saying that he wants the Federal Reserve to drop interest rates so they can issue debt at the front end and get lower interest rates?
He's saying there is a direct connection between the Fed's rate policy and what the U.S. pays in interest payments. And then Scott Bessent came out and said, yeah, we're not going to term out the debt. We're going to focus on the front end because right now the term premium is just too great. So you put those together, and that is, to your point, explicitly calling for the Fed to help the country lower its interest payments.
In the Sharpie, black and white, you have cost the USA a fortune and continue to do so. He's talking about the net interest we are paying on our debt, which has basically toppled the entire U.S. budget higher than defense spending.
Quick final word, dollar weakness. How much of a tailwind is that for the S&P 500?
It's definitely been significant, and it has definitely contributed, among other reasons, for the large cap outperformance over small cap. In general, it tends to be a positive, but again, there's always sort of until it isn't. And I would suggest, and it's not our base case, that there are going to be issues around getting this bill passed. But if we start getting towards August, and again, not our base case,
sure,
that is where you run into problems.
There's so many reasons for dollar weakness, which I think makes the pain trade of Q3 dollar strength. That's got to be the pain trade of Q3, dollar strength. Who's positioned for that?
I couldn't agree more. I was thinking people say that there's going to be a stimulative effect. I know Annmarie would argue with this from the one big beautiful bill. Let's say that plays in with better than expected earnings and economic data. What does the dollar do?
Julian, it's good to see you, sir. Thanks for dropping by.
Thank you.
Julian Emanuel there of Evercore as we kick off the second half of 2025. Up next, the former NEC Deputy Director Everett Eissenstat as the EU comes to the table for trade talks, plus your movers with Danny Berger, the latest on Tesla. Welcome to the second half, live from New York City this morning. Good morning. Your scores look like this. Equity futures negative by 0.2% on the S&P, following back-to-back all-time highs on a benchmark in the United States. We're coming into Q3 on a 3-day winning streak. On the Nasdaq 100, after a major rally off the lows of April, we're down just 0.3%. With 3 hours until the opening bout, let's get you some morning movers. Here's Danny Berger with the latest. Hey, Danny.
Hey, John. A painful pre-market session for Tesla, already down 4 1/3%. It seems that the social media spat between Elon Musk and President Trump having its ramification on these shares, the latest of which after Elon Musk slammed that spending bill. President Trump on Truth Social seemingly threatening to take away subsidies from Elon Musk's companies, hence the decline we are seeing this morning. To the upside, though, the large casino operators, that is Las Vegas Sands, win. Both of them really strong, up more and nearly 3.5% for the two of these. We got latest Macau numbers for those gambling revenues, up 19% for the month of June year over year. The estimate was just 9%. And for both of these companies, about half of their revenue comes from Macau. So that's lifting the shares this morning. Finally, wrapping things up with Robinhood. After already a 13% gain in the regular session yesterday, we're looking at another 3% this morning. Robinhood announced yesterday that it's going to be tokenizing U.S. company shares, which means that if you're in 30 countries, you can trade these shares 24 hours a day for 5 days of the week. So congrats. If you already can't sleep at night, you can also now trade equities, John.
Yeah, Danny, I hate it. Absolutely hate it. Danny, thank you. 24-hour trading. The 24/7 stuff kills me.
Well, I think it kills
Needs to
everyone.
stop. Needs to be a close, right? Need a weekend.
Well, it's good that it's actually pretty calm trading, so it's not necessarily like anything is going to happen if you go to sleep. That's what we learned in the past half.
Crypto bros just can't get enough of it, can they?
They can. They're up 30% on the Bitcoin this quarter, so, you know.
Good for them.
Yeah.
I need a break. On our radar this morning, Senate Republicans working through the night to iron out divisions over President Trump's $3.3 trillion tax bill. Senators expected to vote through the morning with 8 major holdouts remaining.
We're almost at 24 hours here when it comes to these amendments. There are really 2 individuals I'm watching right now. Potentially Ron Paul, someone who was a no. If they are able to lower the threshold for how much they're willing to spend to lift the debt ceiling, maybe he gets on board. And then Senator Lisa Murkowski, they're working on language, especially get a carve out for Alaska when it comes to Medicaid. We are seeing that Vice President J.D. Vance has walked into the Capitol. He would only be there if a vote is close, because he needs to obviously be one of those votes, because they cannot lose anyone else, because the margins are so tight. So that says to me, potentially, we're on the cusp of Majority Leader Thune getting one of those holdouts on board, and then J.D. Vance can come for the final tiebreak.
There's a bit of tension in the room at the moment, but the most interesting feud, I think, is taking place beyond Capitol Hill. It's a feud between President Donald Trump and Elon Musk, reigniting basically over EV subsidies. The president saying Musk may get more subsidy than any human being in history after Musk slammed Trump's tax bill for cutting EV credits.
Yeah, and then he went in on the fact that he's from South Africa, not a true American, and then talked about no more rocket launches, satellites, or electric car production, and our country would save a fortune. Perhaps we should have Doge take a good hard look at this. Big money to be saved. Raises a question of, A, has this feud actually ended? Because we saw a sort of uncomfortable resolution to it, but then also how vulnerable Tesla really is. And I think that the company-specific story is actually more fascinating than anything else. There was a belief that Elon Musk's closeness to the president was going to help Tesla. The reversal of that is calling into question the entire regulatory framework for robo-taxis and beyond that really had given a lot of support to these shares.
I totally agree. The stock is down by more than 4%. What's interesting, though, is the policy they're arguing over is a policy they campaigned on for months. This was the policy we all expected.
And this is the point that President Trump put out there. You and I disagreed on that before, and I was very vocal that I did not want this policy. This is also splitting a lot of Republicans on Capitol Hill, and that is part of the debate that is in the bill. How much is this stimulative to economies that are in red states in a way that they don't want to roll back so quickly, given that there is this emphasis on trying to create jobs?
The President of the United States has been super busy over the last 24 hours, that's for sure, talking about needing sleep and stuff. That guy's not sleeping. Ramping up the pressure on Fed Chair Jay Powell yesterday, writing a letter urging the central bank to cut rates by a lot. Trump then posting Powell and the FOMC should be ashamed for costing the U.S. a fortune.
Handwritten letter, so basically they're pen pals now. What I found so interesting is part of that letter, he says, look here, Japan, Denmark, Switzerland, Seychelles. He's like, look at the rest of the world. They're cutting rates. Why are we not cutting rates? But this comes back to what we were just discussing a few minutes ago. The president has been very explicit. He wants the rate cut because we are paying too much on our debt. And for the first time we've seen, when we pay our net interest on our debt, it is bigger than the U.S. national defense budget. And he's looking at that and he's saying, where can we try to trim? Why are we spending so much money on our debt? If he just doesn't, if he cuts the rates, potentially this is where we could save some money. And he's, according to the president, he thinks inflation's over.
If you're reliant on short-term funding, great, you might get those lower rates. If you're reliant on long-term funding, long-term interest rates, you might have a problem. If they start cutting interest rates in response to this, Lisa, we've been talking about this dynamic for months now. If you see a repeat of what we saw at the back end of last year, you bring the front end down and you see the long end go the other way, try getting a mortgage.
Well, and I would add to that, it will be even worse, because if people perceive that inflation isn't necessarily dead and that this isn't the prudent economic policy, but it's being done for political reasons, then all of a sudden you have a framework where people don't want to buy U.S. assets that's lost that credibility. Julian Emanuel said that the biggest risk case for equities was the 10-year going above 5%. And that is what he expects to possibly be on the table in that type of scenario.
10-year this morning, 419 and down another 4 basis points as we speak. Let's get to some better news for the president. The European Union coming to terms with a 10% universal tariff from the United States. Sources telling us here at Bloomberg that officials are willing to accept a deal, but with key exemptions. Joining us now to discuss is Bloomberg's Ollie Crook. Ollie, what are the key exemptions and why the turnaround from the EU?
Yeah, and I think it's a little bit surprising, John, that, 8 days before the deadline is the moment at which the EU has sort of realized that this 10% is not going to move. That seemed pretty clear from the outset. What they would like to see are some exemptions and quotas to bring the effective rate down on auto tariffs and steel tariffs and aluminum tariffs. Remember, those are at about 50%, auto tariffs at about 25%. They'd like to have some workarounds around that. That'll be pushed very hard by the Germans. But what they would also like to do is get some clarity on the sectoral tariffs. For them, it's like they're negotiating blind, right? If you are going to negotiate a trade deal, and then a couple months later you're going to get hit in the pharma sector, the airline industry, and the chips, and these are the three main sectors that the Europeans are most concerned about, then what good is a deal going to be? So that is really what they're going to be pushing in the last few days that this is going to happen. Of course, we remember what happened with Canada and the digital tax, and that sort of got turned around. There are a number of European countries that have digital taxes. Is that something that's going to come into the fray? So we're really in crunch time for these negotiations. About 8 days to go until that July the 9th deadline. And of course, we don't know if the Trump administration is going to come with more afterwards. That's really the scenario that European policymakers would like to avoid.
Ollie, with the latest, appreciate the reporting, sir. Oliver Crook there out of London this morning. Joining us now to extend the conversation, Everett Eissenstat, the former National Economic Council Deputy Director. Everett, welcome back to the programme. What is your base case for July 9th? Extend and pretend, move on, and drop 10% on everyone? Which one?
Well, I think we're going to see a little bit of everything. I believe there will be an extension of the tariff deadline will be pushed back for some countries. I think we'll have some frameworks announced. But one of the interesting points that was just made that I don't think should be underestimated is the fact that the European Union agreed to that 10% baseline, just as the UK did, United Kingdom. And as you recall, a month ago or so, that was not even on the table for the European Union. So countries are steadily recognizing that they need to adapt to the president's priorities and making that, being pragmatic, they're accepting that and trying to move forward with things that really matter to them.
Everett, 5 days ago, I was in Europe, and they were talking about how they would not accept a 10% universal baseline tariff. So what are they getting for accepting this?
It's a mixed bag. If you think for many of these economies, they just want this to go away and get some kind of predictability. What a lot of the industries are worried about are what's coming down the road. And you've got the sectoral negotiation, or these sectoral tariffs that might come into place under Section 232 national security investigations. We already have very high tariffs on autos and steel and aluminum, and we know more are coming. Pharmaceuticals, you had some of them up there on the big board. pharmaceuticals, semiconductors, copper, timber, many, many important components to manufacturing, and they could be fairly disruptive to the supply chains for a country, for an economy like the European Union, Germany, and some of these big manufacturing, knowing where they're going to be in those sectors is very important. So I think they're willing to accept that 10% baseline, but they need to see and are hoping to see some flexibility in those sectoral tariffs.
So let's talk about two you mentioned when it comes to autos, 25%, and then 50% when it comes to steel. How much lower do you think the United States is willing to go?
I don't think we're going to see an overall reduction for any on the writ large across the board on, say, 55%. It may come down some. I think what we're more likely to see are flexibilities built into that number. For example, if you take the United States UK framework, United Kingdom framework agreement, there's room in there to negotiate quotas. And that's not too dissimilar than what happened during the first administration, where there was a 232 tariff, and then countries got some relief through quotas, exemptions for certain products. So I think it will be more of a Swiss cheese approach where you have the whole there, but there's going to be pockets of flexibility built within it.
Everett, how confusing do you think it is for some of the trade partners that the 232 investigations into national security reasons for tariffs hasn't been completed yet? Those investigations are still underway, and it is unclear what exactly they will establish. How much is that factoring into these negotiations as well?
It's such an interesting dynamic because generally in these negotiations, you know what you're negotiating, you know what the table looks like. And what they're negotiating for now is basically, one, to avoid retaliation in a tit-for-tat trade war, which is a good thing because that could be very destructive to the economies. But they're also negotiating to have a seat at the table when those 232 investigations conclude. And you're right, it is very disconcerting for them to be in a position, for countries to be in a position to negotiate on something that you don't know what the remedies are going to be. So you can talk about generalities, you can talk about, what that you want to be there, you want to help shape it. But until you know exactly what it looks like, it makes it very, very difficult.
You don't really know what you're negotiating. Everett, thank you, sir. The former Deputy NEC Director, Everett Eissenstat, which speaks to the reason why they're so willing just to accept the 10%. Because as you pointed out, Lisa, there's other things to negotiate.
And right now, at least it's not 25% or 40% or 80%, or they just get a letter, like the Penguins.
This is trade on July 9th. Do the Penguins get a letter as well?
I assume that they're not negotiating.
OK, all right. I imagine they're not coming to the table. But who knows these days, OK? Who knows? July 4th is another self-imposed deadline for taxes. We've been tracking events all night in the Senate. Tyler Kendall has more on the nation's capital. Tyler, what's the latest?
Yeah, hey, John. Well, we can confirm that Vice President J.D. Vance is now on Capitol Hill. He, of course, would be that critical tiebreaker vote if it comes to that. We should say, of course, worth reminding on the math, Republicans can only afford to lose three votes. And right now there's likely 2 no's, which means that Senate Majority Leader John Thune is working overtime at the moment to try to get enough Republicans on board. So we could potentially be gearing up for a vote soon. However, I would point out and heed some caution that we've yet to get votes on some critical amendments that could really change the trajectory of this bill, including one amendment that would have a more lenient timeline when it comes to the phase out of clean energy tax credits like solar and wind. So that needs to happen first before we get to any finalized vote on formal passage. And quickly, I would add that we're talking a lot about what the Senate isn't doing, but I would point out something that they did do, which is strip out a provision to prevent states from regulating artificial intelligence. I bring it out because we know that companies like Meta and Microsoft were lobbying for this, and no doubt they're unhappy with the outcome this morning.
Tyler, thank you. Tyler Kendall. With the latest down in Washington, D.C., we'll have more from Tyler in the next hour. We're getting close?
I think we're getting close. Tyler makes a very good point that we are waiting for this amendment from Joni Ernst. And what she's talking about there is when it comes to renewable projects. And this is a big deal. Under the current version of the bill, qualifying projects have to be in service by the end of 2027. What they want to do in this bill, and this would be very much mood music to the likes of Elon Musk and his cohort when it comes to renewables, they want to say, OK, get shovels in the ground by the end of 2027. You could still get access to these subsidies and funds. Not that the project has to be in the works. That is a very big difference.
Making some slow progress down in Washington, D.C. Let's get the latest on news elsewhere this morning. With your Bloomberg brief, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. President Trump has threatened to proceed with higher tariffs on Japan, citing their unwillingness to accept U.S. rice imports despite a shortage. Trump wrote on Truth Social, "We'll just be sending them a letter." The comments come a little more than a week before the July 9th deadline for higher tariffs on dozens of U.S. trading partners. Meanwhile, Apple is considering using technology from Anthropic or OpenAI to power a new version of Siri. Sources telling us here at Bloomberg the company would sideline its own in-house models in a move aimed at turning around its lagging AI efforts. And Boeing CFO Brian West is stepping down. West helped orchestrate one of the biggest capital raises in U.S. history last year. To steady the plane maker, he will leave in mid-August and be replaced by former Lockheed executive Mark J. Malave. Boeing says West will remain an advisor to CEO Kelly Ortberg. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the pushback begins.
We should try to avoid any sort of overshooting. It's much more, the speed of the adjustment than the level. But I think that 117, even 120, we can overlook a little bit, something beyond that.
120 is okay on euro dollar. Anything above that, the ECB raising a flag this morning. We'll have that conversation up next with Erik Nelson of Wells Fargo, live from New York. You're watching Bloomberg TV. Three-day winning streak on the S&P as we enter Q3. Equity futures kicking off the second half just a touch softer, down by 0.2% on the S&P. On the Nasdaq, we're down by 0.3%. Some fireworks in foreign exchange. Under surveillance this morning, the pushback begins.
We should try to avoid any sort of overshooting. It's much more, the speed of the adjustment than the level. But I think that 117, even 120, we can overlook a little bit, something beyond that. This is something that we are monitoring, that we are looking at, but we do not target any concrete level of exchange rate.
So here's the latest this morning. The first sign of ECB officials pushing back against euro strength after the US dollar posted its worst first half performance since 1973. Erik Nelson of Wells Fargo suggests there might be more to come, writing, "We expect a more significant slowdown of the US economy later in Q3 and into Q4, which should drive the next leg lower in dollar short-term rates." Erik joins us now for more. Erik, good morning.
Morning.
What do you make of that pushback coming from Europe this morning?
Well, I think it's not really a function of what Europe is doing. It's very much a U.S. rates move, right? So we're now down 30, 40 bips in between short-term, long-term U.S. rates. And that's really what's driving it. So can the ECB do anything about it? I mean, they could always cut rates. That's always the easy solution. But right now, most of the kind of center of the committee and certainly people like Isabel Schnabel are interested in doing no such thing.
What does it tell you that they're worried about the currency already? What does that tell you about the backdrop for inflation in the Eurozone?
Well, yeah, it's already quite weak. We just had some preliminary numbers from Germany, and it looks like we're going to be continuing to drift maybe even a little bit below 2% on kind of a short-term basis. So that certainly got some of the Dubs worried, understandably so. It's also still, let's be honest, still very much an export, partly more export-driven than most of its peers. So it's a problem for growth.
There are people who heard what you just said and said, wow, that's radical. You just said it's interest rate differentials that have been driving dollar weakness. Is that really true? Or is it the loss of U.S. exceptionalism, the concerns about monetizing debt, this idea of the failure of the dollar to hedge against any potential losses in U.S. assets?
Well, I think those things are all I don't want to downplay them, but I think when you look at what happened in April and May, that was in complete divergence from what was happening with rates. And I think part of that was expectations around growth, right? So we had spent the last 4 months of the year last year and the first month of this year focusing on U.S. exceptionalism, right? It was U.S. growth upgrades in a straight line versus peers. And since then, it's been a straight line the other way, especially during April and May. Liberation Day is really what drove those U.S. growth expectations lower. And part of that also fed into people selling dollar assets, hedge ratios, and so on. But now, just in the last month and a half, the rates have taken back the baton.
That said, economists love a good horror story, and the horror story is United States falling off a cliff and the economy falling in the tanker and the rest of the world taking over. And then people take a look at the actual information under the hood, and it doesn't look like that. What if you get a positive surprise in the United States at the same time that Europe is facing some structural problems and potentially a hit from tariffs and, by the way, a hit from the currency appreciation? How lopsided is positioning right now for that type of thing? To John's point, the pain trade being the dollar stronger.
Yeah, I think it depends on which pair you're looking at. So I think where people have been kind of hiding out is in yen. So people have been very much long the Japanese yen. Positioning in euro is not quite as extreme. So I think that gives a little bit of credence, maybe not immediately continuing the trend, but into the second half of the year, it's not quite so crowded. But I think it's important to keep in mind as well, John at the outset mentioned we're pretty bearish on the dollar versus the euro and so on. In the very short term here, we've got, U.S. short-term rates around 3% on like a one-year forward rate. You're pricing in a pretty significant slowdown. So this week's data is really important to determine, is that happening or is it more of a slow grind towards softness?
Are you surprised that Europe's capitulating on the 10%?
I think they're in a difficult spot. I think everyone is starting to kind of move more that direction, some maybe more than others. I mean, I think the part of the issue here for Europe is that there's a lot of, people, a lot of cooks in the kitchen, so to speak, right? And I think they want to avoid the worst case scenario of just complete collapse, 50% tariff that Trump has talked about. I think when push comes to shove and they actually come to a point where they're putting ink on the paper, I'm not so sure that they're going to be as willing, across the board to accept that. They're going to have to take a lot of quotas, I think, and things like that.
There's going to be exceptions. There's going to be carve-outs likely when it comes to if they're willing to accept a 10% base. What's the reaction from the currency the second Trump comes out and does this announcement?
Well, I think it's a little bit of a different proposition now than it was back in April because growth expectations look a little bit closer to realistic. So there may be a little bit more pushback on the euro strength if you do get a really nasty tariff announcement. But I think the bias here is this is generally viewed as U.S. economic self-destruction on the tariff side. So I think any sort of pullback in euro is probably going to be pretty short-lived.
We haven't seen much destruction. Let's talk about the data. Payrolls on Thursday. The estimate in our survey now coming down to about 110. Is a low number on Thursday a weak number?
I think it's got to be quite weak. I think it's, you look at talking about Bloomberg here, the whispered number, which, gives us a sense of where the kind of cognoscente are going.
Side that anything around 100K these days because of immigration is actually not a weak number. Maybe that's still strength. Maybe that doesn't lead to a higher unemployment rate. What are you and the team thinking about?
That's really a key point. Yeah, I think the break-even rate, as you say, is much lower than it was a couple months ago. So, I mean, we have the unemployment rate eventually getting up to 4 or 5, but not soon. And if you look at continuing claims, that's telling you it's harder to find a job, but initial jobless claims are going nowhere. So this could be a very slow deterioration process.
Some tension in the data, at least for the moment. Erik Nelson there of Wells Fargo. We heard from Torsten Slok of Apollo, last week? Sat in that chair. He said maybe get used to 50K on payrolls, and maybe that's just the replacement rate. For unemployment, you might not see it drift higher, even with numbers like that.
So then what do you do with that? Is it a positive thing? Is that a negative thing? How do you gauge numbers that look dramatically different that are coming in at the weakest on a headline level going back to 2020? Even though people are saying it's not cheering that quickly, it becomes very complicated, and the dual mandate becomes that much more fraught.
I'm just going to say if you start printing 50s, I think there will be some screaming down in Washington about lower interest rates.
I would agree with that, but then are you going to tell Amazon to hire more people and fewer robots? Did you see that story earlier today? I mean, they have potentially more robots than people in the next 6 to 12 months. And I'm just looking at this and I'm like, how do you gauge that out? The technological changes, make robots great again? I don't know.
That chorus will get a lot bigger. But what's interesting when you say that, you're already hearing from a lot of Democrats, and you have been from the likes of Elizabeth Warren. She lines up with Trump on this, telling Jay Powell that he should have been lowering rates for months.
Didn't she call Chairman Powell a dangerous man once?
Yes.
Do you remember that?
I do.
Feels like a lifetime ago, doesn't it?
I keep going back to, if he listened to all of these politicians, would rates be lower on the long end? And that ultimately is the key question that people are not giving a consistent answer to.
Based on experience, the experience of last year, perhaps not. Equities this morning down 0.2%. Up next, Bob Michael of JP Morgan, Henrietta Treyz of Veda Partners, Daniel Roeska of Bernstein, and David Seif of Nomura. Live from New York, the second hour of Bloomberg Surveillance is up next.
What started out as just a relief rally is starting to become something real.
Institutional risk sentiment has improved so much that people are willing to put money to work.
The risk in stocks are a little higher today than they were in April.
All the negative things which could happen have dissipated, at least for the time being.
Does it really make sense for equities to be hitting new record highs? I think that is a pain trade.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
How was all of that just one quarter? Q2. Let's hope Q3 is nothing like Q2. Equity futures this morning look like this, and good morning. We're down 0.2% on the S&P, following back-to-back all-time highs on a benchmark stateside. On the Nasdaq 100, after a major rally off the April low, we're down just 0.2%, close to record highs across the board. Through the week, anticipating lots of data, including the jobs report on Thursday. On Friday, markets closed, but it's a deadline, a self-imposed deadline for what's happening down in Washington, D.C. right now. Live pictures in the Senate as they drift towards a vote on the one big, beautiful bill.
With a consensus coalescing that it might not be on July 4th, as Annmarie mentioned, but that they will get something passed despite these 8 holdouts that are lobbying for some sort of specific deal. When you take a step back, you just wonder how much has changed. You talked about this earlier. Are we heading into the second half with the same presumptions? And the answer is maybe not, given that we have a little bit more certainty that we have this bill and that, frankly, the tariff situation does seem to be facing some sort of resolution.
The bill's going to get done. Does it get done in time? Potentially not. Does it look like it was the one in the House? No, it does not, which is why this is going to get even more complicated when the Senate is able to sign, seal, deliver it back to the lower chamber. J.D. Vance, though, is in the Capitol right now. So clearly they are getting close to potentially needing his tie-breaking vote. What Senate Majority Leader John Thune right now is doing is locking up the final senator he needs, because he knows he's not going to have Tom Tillis. He likely won't have Senator Paul, but maybe he will if they're willing to do a negotiation on the debt ceiling. The individual I'm watching is Senator Lisa Murkowski of Alaska. If they can get language that the parliamentarian signs off on when it comes to a Medicaid carve-out, she's likely going to be a yes, and they can get the show on the road.
As the temperature rises down in Washington, the tension builds between Elon Musk and the President of the United States. It's round 2. A second round of this. Tesla's down in the pre-market by more than 4%. The spat continues to build over something that was obvious several months ago, the removal or the phase-out of EV tax credits.
And initially, Elon Musk said it didn't really matter, and that ultimately it might even benefit Tesla. It doesn't really matter to the fundamental picture. Now it does matter quite a bit at the same time that it's one of the key concerns for a lot of even Republican senators, Republican Congress members who see that there is some sort of economic benefit. When you take a step back, it highlights how fraught it is for someone to be perceived as benefiting from being close to the president, because fortunes can change. And I don't know if you can really extrapolate out in some sort of generality, because this is a very specific situation. But there is this feeling that this is a complete about face for both Elon Musk, the man, and Tesla, the company.
Dan Ives just published. Of course, he's been watching this beef, and he says the best friend forever situation, he says BFFF, has now turned to soap opera that remains an overhang on Tesla stock, with investors feeling the Trump administration will be more hawkish and show scrutiny around Musk-related U.S. government spending related to Tesla, SpaceX, and most importantly, the autonomous future with the regulatory environment. That is why the stock is down this morning.
Spare a thought for these guys. Can we have some sympathy for central bankers? Like that much this morning, maybe? Small violins? OK. 9:30 Eastern Time. Chairman Powell sitting down with ECB President Christine Lagarde and Governor Ueda of the Central Bank of Japan in Sintra, Portugal at 9:30. What on earth do these guys do? The fact of the matter is, apart from Chairman Powell, some of those guys have been doing quite a lot.
Yeah, and actually, Christine Lagarde came out in a speech and comments over the past couple of days and talked about essentially scenario analysis, which hints at something, I don't want to say dual mandate-like, but looking at potential risks in a forward glance at potential policy. I just wonder how much they address tariffs, how much they address inflation, and whether inflation is coming in at a time where European inflation came in lighter than expected this morning. I mean, there are a whole host of things that become very complicated when they're looking forward at a time where the crystal ball is quite murky.
The elephant in the room, of course, is going to be the president, who just sent that letter to Jay Powell. They're now pen pals. And Christine Lagarde, who the president has been praising for cutting interest rates. But I have the smallest violin for them, because this conference is held in Sintra, Portugal. Absolutely stunning.
Beautiful, 40 degrees or triple digits here, stateside and no aircon.
Yeah.
Lovely stuff.
Yeah, I guess that, we can actually feel bad for them.
Imagine maybe they've got some aircon. Who knows? Coming up this hour, Bob Michele of JP Morgan with stocks notching a second quarter comeback. Henrietta Treyz of Veda Partners as the Senate pulls an all-nighter. David Seif of Nomura expecting a lackluster 90K payrolls print this coming Thursday. We begin this hour with stocks steady after the S&P 500 notched its best quarter since December 23. Bob Michele of JP Morgan writing the markets are in a good place in the aftermath of the Middle East ceasefire and progress on both tariff negotiations and the one big, beautiful bill. Bob joins us now for more. Bob, good morning.
Good morning.
Is the big, beautiful bill beautiful for bonds?
First, John, happy Canada Day.
Oh, thank you so much.
Former central banker Mark Carney would appreciate the acknowledgement. He's had a tough previous week. So
are you done? Is there more? You can carry on if you want.
No.
Okay, that's done.
Let's go to your question.
Canada's out of the way, please, if you've got time.
I heard you say earlier, I hope the third quarter is nothing like the second quarter. I wish the third quarter is exactly like the second quarter. Think about it. Yields are lower, equity prices are higher, and overcrowded dollars sold off a bit. It was all good, and there was so much volatility during the quarter that for an active manager, you had a lot of opportunity to move positions around. So I would love that quarter over again. We're not going to get it. So everything is more stable right now.
So, Bob, happy Canada Day. I appreciated that, by the way, and I was waiting for you.
It means a lot to him, clearly.
It did mean a lot, although you didn't break a flag, so I don't know. But I am curious going forward. You said it's going to be a lot more stable, which is problematic for people who want to win on the trading. What makes you think it's going to be more stable when we still have these levels of uncertainty and potentially upside surprises to inflation later this year?
Because there are a lot of policies the administration tried to get out of the way. Everything, everywhere, all at once. It feels to us they're trying to clear the deck before the end of the year so that when you roll into next year, you have a smooth run into the midterm elections. They learned from Trump term one. If you lose the midterms, you lose the second half of your presidency. So I think they want to get all the nasties out of the way, come to resolutions on tariffs, on the One Big Beautiful Bill Act. We'll start tackling things like deregulation, get all the dust settled as we head into the fourth quarter, and then the markets can react to everything. They'll have the information.
Do we put the handwritten note to Jay Powell under the rubric of the nasties? I mean, in other words, is this going to potentially be a threat in the second half at a time when you could potentially get a Fed that does cut rates into potentially a more dovish Fed leadership in 2026 at a time where growth might surprise to the upside with some of the stimulative effects of this bill in Washington?
So the back and forth of the president to Jay Powell is nothing more than entertaining. Jay Powell is not going anywhere. He walks in every day and tries to do what's best for the country. And I believe the FOMC tries to do that as well, although it appears that there are some open mic auditions down at the Improv for the next Fed chair. So put that aside, they're doing the right thing. I wish in these interviews with the Treasury Secretary Bessent, someone would say, you know what? If you want yields to come down in the long end so that mortgage rates come down, you should actually be asking the Fed to hike rates 100 basis points in there, because that will bring rates down in the long end. Because with the kind of softness we're now kind of seeing in the labor market, we haven't seen the full impact on tariffs. We know businesses and household rolled a lot of the spending forward into the first quarter. They're in a pause mode. Hiking rates here is what would really bring long rates down.
Bob Michele, thank you, because we've been talking about this now for months. The experience of last year, the cut rates 100 basis points and yield to the long end actually rose. Do you see a risk of that developing this year, or are things different this time?
I think we're getting past that. I think there was a lot of deleveraging in the long end. I think there was selling. I think what you're seeing now is money's coming into the bond market. It goes into things like income funds and aggregate bond funds, and they buy across the curve, and it's starting to support the long end. The long end looks structurally cheap to the front end now. I think we're past the point about worrying about how the U.S. is going to fund itself.
Are there fundamentals that support that appetite for longer-dated bonds?
Well, the fundamentals are going to come from long-dated buyers, so pension funds and insurance companies that have long-term liabilities that they have to defease. They pretty much own that market. And what we're seeing right now is a sense that yields don't look too bad where they are. When you start looking at the corporate market, the all-in yield looks pretty good. If things do start to slow down, and the Fed actually does start to bring rates down once, a couple times more, because of a softening in the economy, because the labor market's starting to weaken, you're likely to see that parallel curve shift lower that Treasury Secretary Bessent was talking about. So they don't want to miss it.
This sounds like the backdrop that we would have been talking about, the investor buyer base, maybe 6 months ago. Supposedly that all changed. Foreign investors fled, even long-term institutions, and you have this real question about vigilantes with their pitchforks coming out and protesting the bill in Washington, D.C. What happened with all of that?
So the foreign investors never actually fled, and we've been saying that for a long time. We deal with a lot of foreign investors. I went to Tokyo a couple months ago, met with a lot of big foreign investors. They continue to put money into the U.S. bond market. There may have been a pause for a week or so, but there was no net selling. And we've seen that in the tick data. We've seen that in the Fed's custody data. They've been coming into the auctions and buying. What they have been doing is thinking about owning U.S. dollars versus their base currency. So they continue to buy U.S. assets, but this time they're less interested in taking the U.S. dollar and more interested in hedging some of that back to their base currency.
So they're not selling dollar assets, they're hedging the U.S. dollar. That's been the theme, hasn't it?
Which led to the surprising occurrence where you saw decent performance in stocks and bonds, but the dollar falling out of bed. And can that continue as sort of the one expression of concern about the U.S. budget and some of the policies?
Bob Michael at JP Morgan's going to stick with us. Lower yields again today. We're down 4 basis points. It's a break of 420 on 10s, 418. With an update on stories elsewhere this morning with your Bloomberg brief, here's Yahara Anand with more. Hey, Yahara.
Hi, John. Senate Republican leaders continue scrambling for votes to pass President Trump's $3.3 trillion tax and spending bill. They've been up all night and are continuing to vote on amendments to the legislation amid deep party divisions over clean energy and Medicaid cuts. There are currently 8 major Republican holdouts. Meanwhile, President Trump is attacking Fed Chair Jay Powell again, posting on Truth Social, quote, Jerome Tulay Powell and his entire board should be ashamed of themselves, adding, if they were doing their job properly, our country would be saving trillions of dollars in interest costs. We should be paying 1% interest. That message from Trump was also sent to the Fed chair in a letter. And Amazon is taking its automation efforts to new heights. The Wall Street Journal is reporting the e-commerce giant has deployed over 1 million robots in its facilities. That's the most automation the company has ever had and is nearing the count of human workers. Around 3/4 of Amazon's global deliveries are assisted in some way by robotics. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later this hour. Up next, shoring up support on Capitol Hill.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. We're all on the same page on how to grow the economy while controlling and bringing down expenses.
Joining us in just a moment, Henrietta Treyz of Veda Partners, and Bob Michael has a whole lot more to say about that tax bill. Live from New York City this morning. Good morning. Just heard from a Bloomberg subscriber. If you went to sleep in February and woke up today, no change, except for the US dollar. Didn't feel like that, did it? Equity futures right now on the S&P, negative by 0.2%. On the Nasdaq 100, we're down by 0.25%. With all eyes on the nation's capital under surveillance this morning, shoring up support on Capitol Hill.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like. We're all on the same page on how to grow the economy while controlling and bringing down expenses.
Here's the latest this morning. Senate Republicans pulling an all-nighter, looking for votes on the one big, beautiful bill. Henrietta Treyz of Veda Partners writing, eventually the rubber will have to hit the road, and we expect that the House will roll over and accept the Senate's more material deficit increases. Henrietta joins us now for more. Henrietta, welcome back to the programme. Just describe what's taking place in the Senate right now and whether you believe we're pretty close to getting this done.
Yeah, it looks like we're in force-it mode. We've got J.D. Vance going up to the Senate, clearly indicating with some muscle that he's there to break a vote if he needs to and be the holdout. But I want to just emphasize one thing here. Him having to vote for the bill now means that over the last 72 hours, the trajectory of this bill has actually lost a senator along the way. So his vote was not needed for the motion to proceed on Saturday night, and now it is. And that's obviously not a good sign. And I think a big part of that could be the distributional tables that were released by the JCT at about 2 o'clock this morning, which show the top bracket is going to see $12,500 when this bill is passed, and the lowest bracket is going to see $150. So that's really the fallout here. That's what's got Alaska all flipped out. We've got some problems still.
Henrietta, is it, when it comes to the senator of Alaska, Lisa Murkowski, is she the one that Majority Leader John Thune has to flip?
She's essential to the package. What we always watch, and it's been decades now, is the combination of Collins and Murkowski. And let's not forget that Dan Sullivan is one of the Alaska senators that's actually up next cycle. So when you get 35% of the Medicaid recipients in Alaska that are under risk of seeing their cuts or their health care lost, that's a material problem for the state. But then we still have the IRA issues that are critical to Maine and a whole host of other states as well. So I think we actually have a little bit longer to go before this is all nailed down.
In your note, you think that in the end, the final passage will get Murkowski and Senator Collins' vote. But Senator Collins had an amendment earlier this morning when it would give more money to rural hospitals in lieu of raising the tax rate on those making $25 million or more. And that was struck down. So is she a no now, given her amendment went down in flames?
In my experience, that's more of a messaging document. You're not going to get Republicans to vote for tax increases for any individual brackets. Even President Trump tried to do that earlier on in the year, and the party killed it pretty quickly. So I see that more of as a message and, pretty serious signal to Senator Collins, who is also up for re-election next cycle, that she has another workaround. But the fact, again, that Vance is there means she might be a no vote. And she made it really clear during the motion to proceed on Saturday night that she was only voting to proceed. She did not have support for the underlying bill. So Vance being there suggests that they have lost a senator from the process alone.
Henrietta, then this goes to the House, and you think the House just accepts it. Although we're already seeing some House members come out, the SALT caucus, I don't like what they did to tweak what happened with the SALT cap. You have the House Freedom Caucus saying, actually, this raises the deficit. We're going to be increasing spending. Why are you so sure the House is just going to take this on the chin?
Yeah, and I'm sorry, it's been a long night, but I got to say the SALT caucus has to sit down. I mean, they've gotten enough of their carve out. They got a $40K cap. They've got it up to $500,000 for an income bracket. So they've gotten what they're going to get. That's why the distributional tables are so bad. I would really expect that the Murkowski-Ernst-Grassley bill on the IRA or the amendment has to pass in order to satiate the House IRA supporters, of which there are anywhere between 18 and 30 members. To me, that's a bigger caucus than the SALT conference, who's already gotten as much as they can ask for, much more than I anticipated, indeed. So I think that they need to sit down and we need to move into the IRA place. We haven't even gotten an amendment vote on that bill yet, so we need to see that happen.
We're getting closer. Henrietta, thank you. Henrietta Treyz there of Veda Partners. We're getting closer and bond yields are falling, not rising. We're down 4 basis points on 10s, 4.19. Bob Michael at JP Morgan still with us. This is about to pass and bond yields are falling, not rising. Does this nation's deficit and debt matter to the price of treasuries?
No, it doesn't. And I think more bad decisions have been made about buying and selling treasuries on the amount of U.S. debt out there than anything else that's come along. So look, we in the market have gotten our head around, we're going to see a one big beautiful bill. It's going to increase spending over 10 years, 2.8 to 3.2 trillion. I don't know where CBO scoring is at this minute, but it's somewhere in that vicinity. It could even be a little bit higher. We get it. Does that mean that the Fed can bring the Fed funds rate down to 3%? Probably not. Can they bring it down to 3.5, 3 3/4? Probably, because you still have the tariffs hitting first. That 10% baseline tariff has been in place for several months already. Businesses and households are pausing a bit. You do need this one big, beautiful bill to come along and give some impetus to the economy. It could be an interesting balance here. I think we in the markets are over it.
Maybe it's because Scott Bessent is not over it and has been really focused on that 10-year yield and keeping that lower, and a real question around what the Fed will do, what this president will jawbone for in order to keep borrowing costs relatively low for the United States. Does that affect where the bond market is viewing this, the fact that the U.S. might not issue as much in the long end, that they will adjust depending on the market's response?
If I were Bessent, I would take the win. I've said all year it's a shock to me that the 10-year didn't get to 5% and stay there. You've got a 4 3/8% Fed funds rate. They haven't cut rates in 7 months. All these rate cuts that people had, 4, 5, 6 this year, they've had to take off the boards, yet it's been really hard to move the 10-year too far away from a 4.4% yield. That's pretty much flat to the Fed funds rate. So there still is a tremendous amount of demand for bonds. There's a tremendous amount of demand for treasuries. We didn't get to that 5% level despite all the inflation and growth impact you could see from policies coming out of Washington. So I think the Treasury market's in a really good place right now.
So with due apology to Ed Yardeni, but do you think that the concept of a bond vigilante is a myth and not reality?
I think so. I think it would be nice if we could put on a mask and jump on a horseback and ride through and drive the markets wherever we wanted them. But you know what?
They're the good old days, Bob.
They were. It was. But look,
with the Canadian flag.
The amount of bond investable assets no longer sits on broker-dealer balance sheet looking to be traded or hedged or moved or repriced. They're sitting in end client portfolios, in wealth management accounts, in pension funds and insurance companies. That's where the bulk of the AUM is, and that's pretty stable. I look at the amount of cash that's still in the system. I saw an interesting stat a week or so ago. We're watching money market fund assets, that's $7 trillion. When you start adding in checking accounts, deposit accounts, savings accounts, suddenly you're over $21 trillion in liquidity. That's a new indoor record, and it still keeps rising. So there's a lot of money sloshing around in the system. Everyone feels a sense that they've missed something. They want to get in the market somewhere. I've got a call tonight with Australia. I've had many calls yesterday. I've got more. Everyone is asking me, where do we get in? How do we get in? What do we buy? What do you think going forward? Nobody's asking me, how do I get out of the bond market yet? I've been saying that all year, and here we are, lower yields. I'm not that surprised.
What about Section 899? Are people now feeling like they're more willing to get in front of U.S. assets because that's been stripped out of this bill?
That was a concern. I think, by and large, the overseas investor looked at that and said, that can't possibly happen. When we get down to talking about the specifics and the unintended consequences of some of these policies, that will be taken off the board. I was more concerned than a lot of our foreign investors were. They proved to be right on this.
Bob Michael of JP Morgan on the bond market. Bob, thank you, sir.
Always
Appreciate
a pleasure.
it. And thanks for the 2 Sundays we spent with you in Q2 as well, which now feel like a lifetime ago, right? Feels like a lifetime ago.
Yeah, he says that he would want a repeat of this. I love spending Sunday evenings with you. Let's hope that there aren't that many more of them.
A repeat of the price action, just to be clear.
Exactly.
Sure, Bob's going to take that. I'm not sure about the work that went into it. Up next on the programme, it is Trump versus Musk, Volume 2. Daniel Roeska of Bernstein with EV credits on the chopping block, plus Danny Berger with your morning movers with the impact on Tesla. Three-day winning streak coming into Q3. Equities pulling back just a little bit. No drama whatsoever. We're down 0.2%. Plenty of drama elsewhere. We'll get to that in just a moment. We're down 0.25% on the Nasdaq 100. With your morning movers, let's cross over to Danny Berger. Morning, Danny.
Good morning, John. And a taste of that drama for you. Tesla shares in the pre-market down just under 5%. It's the back and forth between Elon Musk and President Trump over social media. Elon Musk slamming the bill, making its way through Congress right now. Trump on Truth Social last night, seemingly threatening to take away some of Elon Musk's company's subsidies. Hence, you get the drop in Tesla, showing just how sensitive it is to that. Moments ago, we also got a press release from AMC announcing an agreement with creditors in which it would take out about $223 million of debt. It would use that to pay down a line of current debt that expires in 2026. Maybe a little bit of extend and pretend. Shares down more than 1%, bouncing around a bit this morning. It's also going to be a dilutive event. It's also going to equitize about $143 million of existing debt as well. So that has shares off this morning. Finally, wrapping things up with some sell-side action for you. TD Cowen downgrading the salad chain Sweetgreen to a hold, saying that it's done channel checks and it suggests that stores that are at least 4 years old are going to be facing double-digit declines in same-store sales. It also doesn't like its new strategy of moving to more suburban areas, says it's unproven. So, John, the pushback against $20 salads, it's real apparently.
It is, and the chicken was getting worse as well over the past few months.
There's
just
a real problem.
Throwing that out there. Of course, that's a very personal opinion, but just throwing that out
Anything
there.
else?
When companies go public, these things tend to happen.
My issue is just that the portions get smaller and smaller. So
Much
if you get
smaller.
the salmon, it went from like this to like this.
Portions come down, quality gets
Yeah,
worse. And
people are a little meaner.
see that across the board. They're meaner to you. That might be a personal thing. All right. On a radar this morning, Senate Republican leaders pulling an all-nighter, looking to shore up support for the president's tax bill. Vice President J.D. Vance at the Capitol right now. He would cast a tie-breaking vote if needed to get the bill across the finish line.
So the music looks good when the vice president shows up to the Capitol. It means that likely we could be close to a vote. They've been doing this vote-a-rama, these amendments, since 9 a.m. yesterday. So this has been a slog, an all-nighter. The individual I'm looking out for is Senator Lisa Murkowski of Alaska. They were trying to work on language to get a Medicaid carve-out for her state. But Henrietta Treyz brought something up that I think might hurt the Republicans going into the midterms. The Yale Budget Lab yesterday. Changes to taxes and Medicaid and SNAP spending proposed by the Senate budget bill would result in a decline of 2.9% in income for the bottom of America, but an increase of 1.9% for the top 1%. That is why the likes of Lisa Murkowski and Susan Collins are saying we need some carve-outs for our states.
The Treasury Secretary Scott Bessent was speaking to the American media just moments ago. He said the tax bill more than pays for itself. On this spat with Elon Musk, I admire Musk on rockets. I'll take care of the finances.
Yeah, well, the Musk point, I will leave that to the side for 1 second. The idea of the tax bill more than paying for itself really stems from the idea of tariffs on the other side of this. We've been talking about the connection between July 4th and July 9th and how that's not being accounted for necessarily in some of the budget estimates.
These two stories are connected. The latest on tariffs sounds like this. Some tension between the US and the Japanese. The president contemplating higher tariffs on Japan. The president saying, quote, they won't take our rice, and yet they have a massive rice shortage. In other words, we'll just be sending them a letter.
So this was my rabbit hole today, was rice in Japan, which is actually fascinating.
Stage is yours.
Okay, so in the 1970s, there was incredible oversupply in Japan that led to a plummeting in prices of rice. Some of the rice farmers were incredibly politically connected and savvy, and so they got certain limitations or restrictions that allowed them to only produce a certain amount and really keep prices high. They removed those, but they get benefits if they stick to certain quotas. So they don't produce too much. So this is true. But at the same time, they don't want to accept rice from the United States, even though the price of rice has doubled since 2023 in Japan, causing a real political issue among consumers because, guess what? Those rice farmers are pretty politically connected.
The rice lobby is the third rail for Japanese politicians, the same way when you see a U.S. politician come out and talk about potentially raising retirement age or cutting Social Security, it's not going to fly. What I find so interesting about this whole trade story right now with this administration as we look into July 9th, they're looking at potentially getting a deal with the European Union before Japan. Japan and India were supposed to be right out of the gate, quick agreements. Now it looks like the pecking order is starting to change.
Has shifted. The EU willing to accept that 10% universal tariff. The tension, though, as Lisa pointed out, is going to come later. It's the debate over the exemptions and the tariffs on certain sectors.
Well, especially when you're talking about these personal prides for all of these countries. You talk about chicken in the European Union. You talk about rice in Japan. They're all of these sort of national champions that you have to somehow work out.
The national champion of Europe are chickens. Is that right?
Well, I'm just saying there's a lot of national champions of food.
You were doing so well on rice.
Okay, like how about champagne in France? I mean, going after every single aspect. Cars in Germany. I mean, it's literally every single national champion. Okay, fine. Maybe chickens are not,
You're back in the game. Let's turn to
British
Apple.
chickens. Very good.
Yeah, OK. Apple weighing using AI technology from OpenAI or Anthropic to power a new version of Siri. Sources telling us here at Bloomberg that Apple has asked both firms to train versions of their large language models to run on Apple's own cloud infrastructure. Now, this could be a massive shift for Apple strategically, which typically tries to do a lot of things in-house. I also think it's a massive concession that things aren't going so well internally.
Which was the reason why it was interesting that the stock price went up in response to this. People saying, finally, you guys are just really seeing the light, that you aren't succeeding at really competing at the level you need to be competing with, which really goes to the heart of what is the new technological advancement that Apple's going to come to prove that it isn't just the laggard of the Mag 7.
Ed Ludlow on the West Coast in about 40 minutes from now, joining this programme. Less on rice and chicken. Much more on Trump versus Elon Musk. Musk slamming Trump's tax and spending bill. Trump firing back saying, quote, Elon might get more subsidy than any human being in history by far. Perhaps we should have Doge take a good hard look at this. Big money to be saved. Joining us now is Bloomberg's Craig Trudell. Craig, welcome to the programme. Before we get knee-deep in all of the sparring between the two, I just want to understand how different what is being proposed this morning is to what we heard on the campaign trail, because for us around the table, it doesn't sound too different at all.
Yeah, you know, I think this phasing out of tax credits and you know, specifically as they apply to electric vehicles is consistent with what Trump campaigned on. And I do think that there's an attempt here on the part of Trump and you know, Republicans to kind of make this into, oh, Musk just doesn't like that we're cutting subsidies for his electric cars. I do think that we have to sort of acknowledge that Musk has you know, put forward a more nuanced argument here of you know, fine, you know, do away with subsidies for electric vehicles, but let's also do away with subsidies in general. I think he has a much broader beef with just the amount of you know, money that's being, you know, added in this budget, the amount of debt that the country is going into. And he has talked for years about doing away with subsidies. I think there's just, of course, rightfully, you know, a case to be made for the idea that, you know, he at the same time is sort of talking out of both sides of his mouth and saying, well, you know, if we're going to do away with these subsidies, we're doing away with sort of what ought to be the future of the economy and the future of the U.S. economy in particular.
It's certainly hurting the stock this morning. We're down 5% at the pre-market. Craig, thank you. With us around the table, Daniel Roeska of Bernstein, a much-followed analyst on this name and across the industry. Daniel, good morning.
Morning, John.
This is what we expected to happen. How does it change the industry?
I don't think what happened over the past 24 hours really changes the industry. What you need to remember is a big portion of the Tesla stock is held by retail investors. And so as you get big news items, maybe things that we've been following for months now, rise to their attention, and that triggers some of the movement, I think.
What does it do to the EV industry in the United States that already has sort of fallen behind when it comes to the amount of adoption?
I think the U.S. is really a bifurcated market, right? On average, we're at 10%, but we've got a couple of states at 20% EV sales and a couple of states close to zero. And I think it will really make it hard for those states that haven't seen EV sales, Mississippi, Alabama, kind of some of those states, to start buying EVs. And so that really puts big pressure on automakers that they're faced with some states where consumers like EVs and buy EVs and some states where they don't.
There are these highfalutin goals that auto manufacturers in the U.S. would achieve, a high percentage of all of their cars coming out being electric vehicles over the next 10, 20 years. Are those all gone?
If you go back to that period, 2019, 2021, just when Tesla was taking off, there was a big hype in the industry, at this table, and everywhere else on Wall Street. And I think the automakers got caught up in that to some degree. and thought this would go a lot faster, but it didn't. And they've been caught off guard with production plans that really don't fit consumer demand at this point.
What you see happening in terms of the subsidies being taken away, do you think this puts EV makers in the United States at a big disadvantage from, say, like BYD?
It depends on where you compete. I think in the US, we're not really seeing competition with BYD, and so you got to look in the US who's getting incentive and who isn't. And I think in the US, this is mainly a consumer question. You know, do you want to sell more EVs and do you want to incentivize the consumer? The real strategic risk against global competitors is 5-10 years down the line, because of course, if consumers don't demand as many EVs, there will not be as much research in EVs in the US. And the technology that companies like Hyundai, Kia, but also BYD build will be far superior than the ones the US manufacturers will have.
Would this fight with the president impact Tesla when it comes to the regulatory environment?
Well, as we've said before, the cancellation of EV credits will put a dent in demand, and that will hurt any EV maker in the US, including Tesla as well, but everybody else who's been collecting subsidies as well, like GM, for example. We've seen in other countries like Germany or France or Norway, when incentives were kind of taken off, demand drops precipitously, right? And then Norway actually reverted, went back, and now we have a very high penetration in Norway. So it's not to say that this is the end of EVs. It's a big bump in the road. It's probably more like a cliff. But I don't think the U.S. industry will end up just being ICE cars in the end. We will transition to EVs, but it'll take much longer.
It's going to take longer, but you nailed it. The production mix isn't where the consumer is. Who's in the sweet spot? Who's got it right?
Right now, I think everybody's scrambling, because everybody was planning with like 40-45% EV production by 2030, and that's not going to happen. So everybody's on the back foot. Stellantis is, in my view, in the best position because their new technology platform is flexible between ICE, hybrid, and EVs. And so using those same production assets to just make more combustion engine cars is possible, whereas it's much more difficult for somebody like Ford or GM.
Is that your preferred stock?
Across all of them we cover, yes. We're short the lot, with the exception of Stellantis, whom we're a market performer on. And that's more the market, right? Tariffs are coming in, consumers weak. We're going to see SAR dropping down. But yeah, Stellantis over everybody else right now.
Just how much are prices going to go up just across the board because of tariffs and some of the production complicated aspects that we hear about all the time?
Tariffs give you about a 6 to 10% headwind on the price. So if you look at the price, 50,000 rounded bound in the US, the tariff is between $4,000 and $6,000. OEMs will not be able to eat all of that. They've been internalizing quite a bit. We'll see that in pretty challenging Q2 numbers. But our estimation is that half of that goes to the consumer and half of that will need to be carried by the OEM.
Daniel, enjoyed this. It's good to see you. Thanks for dropping by. Daniel Roeska there of Bernstein. Tesla, the stock to watch in the pre-market, down at the moment by about 5%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Back with us. Here's Yahara. Hey, Yahara.
Hi, John. We start with the latest on TikTok. The prospective buyer of its U.S. operations that President Trump referred to over the weekend is said to be the same investor group that bid earlier this year. It includes Oracle, Andreessen Horowitz, and Blackstone. That's according to sources. The group's first bid for the app stalled back in April as trade tensions between Washington and Beijing ramped up. Meanwhile, Meta CEO Mark Zuckerberg announcing a major restructuring of its AI group, which includes a series of new hires. We have been reporting on this, but now it's official. Meta's AI efforts will fall under a new group called Meta Superintelligence Labs. Alexander Wang, former CEO of Scale AI, will lead the group as Meta Chief AI Officer. And the WNBA is expanding. The league has announced new teams in Cleveland, Detroit, and Philadelphia with a record expansion fee of $250 million each. Each team will launch between 2028 and 2030. The WNBA is also in the midst of negotiations with its union for higher pay and minimum facility requirements for players. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, a shaky employment picture.
There's probably a bit of a back and forth on the data front. You know, the employment market is probably, at least in our estimation, the shakiest parts of the current setup. In this environment, what may go wrong is a softening, weakening labor picture.
Up next on the programme, David Seif of Nomura. David looking for a soft number this Thursday morning. Live from New York City. Good morning. The Treasury Secretary Scott Bessent speaking just moments ago with this to say on the Federal Reserve. Maybe the Fed is waiting too long to cut interest rates. Well, the man himself can speak for himself a little bit later this morning at 9:30 Eastern Time. Chairman Powell on a panel in Sintra, Portugal, alongside his peers, the ECB President Christine Lagarde, Governor Ueda of the BOJ, among others, at a time where he's getting some increased pushback from this White House. In the equity market at the moment, the S&P 500 shaping up as follows. Equity futures negative by 0.2% on the S&P. On the Nasdaq, we're down by a quarter as we anticipate more economic data through the week. Under surveillance this morning, a shaky employment picture.
There's probably a bit of a back and forth on the data front. You know, the employment market is probably, at least in our estimation, the shakiest parts of the current setup, meaning there's a lot of underemployment. We think that businesses writ large are still very cautious. I think in this environment, what may go wrong is a softening, weakening labor picture.
So here's the latest this morning. Investors counting down to June payrolls out on Thursday. The estimate in our survey expecting 110k jobs added. David Seif of Nomura falling below consensus, writing, we expect a lackluster non-farm payrolls of just 90k. The US labour market is clearly cooling, but it is not collapsing. David's here with us in New York. David, good morning.
Good morning.
90k is a low number. Is a low number a weak number?
Well, that's interesting. The question is what has happened to trend NFP, or what is the NFP necessary to keep the unemployment rate steady? And it does seem to have fallen quite a bit in the past couple of years due to immigration coming down more than anything else. And so probably trend NFP is still over 100K, but it's not much over 100K. So is this a weak number? Yes, if I have to answer in one word, but only a little bit if I'm allowed to go a little longer than that.
Here's another way of asking the question.
Yeah.
If we get 90k, is unemployment going up?
Well, we think it's going to go up to 4.3, but really that's a very small change. So we had 4.2 in the last print, but it rounded down to 4.2. So we're talking about just a tiny increase. And really, you know, our expectation for the second half of this year is we're going to have an average NFP only in the mid 80s, and unemployment rate's only going to go up to about 4.4% on that. So really just doesn't take as much to keep the unemployment rate steady anymore because there are fewer workers entering the economy each month.
To John's point, if we do get smaller numbers, and they aren't necessarily weak per se, but sort of the new normal, where there just is less dynamism, was this the real picture that we can look for going forward, where there just is less hiring, less firing, less job creation, less job destruction, less motion in the U.S. labor market than there has been traditionally?
Yeah, well, there's definitely a lot less motion. I'm not sure that the 90K is really the best indicator of it. You know, when you look at NFP, you're just looking at the net number. You're looking at the number of people who lost a job and the number of people who got a job. What's really been interesting and really been going on since 2022 is that the gross numbers, the gross flows into new jobs and out of jobs have both come down a lot, or at least the number of people being hired has come down a real lot. So if you have a job right now, even with the cooling economy, even with the cooling labor market, you're about in as good shape as you've ever been. If you are one of the unlucky few who has lost your job, or arguably even worse, if you're in a cohort like college grads who's looking for a job, things look a lot worse for you than you would expect from a 4.2 or 4.3% unemployment rate.
I guess the question is this a sign of weakening to come, or is this a sign of an ossification of the U.S. market that's new, that's more like Europe and less like the U.S.?
Yeah, it does look a lot like Europe, and I think that the jury's still out on that. Is this a permanent thing, or is this what we're going through in this cycle? I think what we saw in 2020 is companies in the United States vastly overfired. They came to regret that pretty badly a couple of years later. And you had companies scrambling for jobs for workers in 2022. And now there may be a sort of pendulum swinging the other way. Now they're reluctant to get rid of people more so because they remember that. I will say that, you know, it's obviously great to have job security, but part of what has really defined American exceptionalism is the churn in the labor market, that companies will renew. There's sort of this creative destruction in all sorts of different levels. And if you do lose a job, it's not the disaster that it would be in many other countries because there's so much hiring going on.
What does the Fed do with this?
Well, I don't think the Fed does that much about sort of a slowing gross numbers. The Fed has to really focus on the overall unemployment rate and, of course, on inflation. And so I think that really with only one instrument, the Fed funds rate, to hit two different targets already, it doesn't want to start creating more targets for itself, so to speak.
Is there good reason to believe that your mandate might be in conflict by the time we get to the end of the year?
Well, I mean, the Fed is being pulled in two different directions right now. No question about that. That's par for the course. So labor market's cooling. That makes them want to cut. And I think that the Fed would have continued cutting already this year had it not been for the prospect of tariff-induced inflation. And now I think Powell has pretty clearly communicated that this is a wait-and-see mode. And so we think they need a few more months of no inflation before they would be comfortable cutting again, unless there's a real negative surprise on the labor market.
He goes beyond that, though. He doesn't just say it's a wait-and-see situation. He says the data and the economy is solid enough, and that's a reason for us to wait. We can wait. Do you describe it as solid?
I think that solid is it's fading a little bit, the word, but I do think it's still fair to say that. I mean, 4.2, 4.3% unemployment. That's still really low. I mean, the Fed's never exactly defined what quote unquote full employment is, but this has got to be pretty close to what it is. So we think the unemployment rate's going to creep higher, but got to remember that the Fed's still well above its mandate on inflation. And so to the extent that it has to prioritize hitting both of them, it has to focus on the one where it's further away from its target.
That is precisely the argument that Esther George, the former Kansas City Fed president, made on this program just yesterday. David Seif there of Nomura. David, thank you.
My pleasure.
Appreciate your time. Looking ahead to payrolls Thursday, of course, not on Friday because of the long weekend here stateside and the July 4th holiday. The number we're looking for on Friday in our survey, putting together all the estimates from Economist, 110K. David there looking for something closer to 90. Also tracking the latest down in Washington, D.C., looking ahead to this self-imposed deadline on Friday, July 4th, to pass the tax bill. The President of the United States speaking just moments ago.
Right, he's walking out to Marine One. He stopped to talk to reporters. Obviously, they're asking about what is going on right now with the One Big Beautiful Bill. He says we're going to get there. He says he thinks they're doing well. When you asked about, do you think they're cutting too much? I don't like cuts. Obviously, this is not going to be good for the president going to the midterm elections for his party.
Which raises the issue of how much they're going to backtrack, backfill, push out some of the deadlines of the expiration of certain benefits and leave the deficit in a much more significant case. I mean, again, all roads point to Washington, D.C. spending more and spending it with debt. And that seems to be the likely path of travel here.
I think you asked a few months ago, where the hawks? Where the fiscal hawks? Don't appear to be in the Senate, do they?
There's a few, one or two, but no, they're all fiscal hawks until it comes to their state. I spoke to Steve Dennis this morning, who's our Senate reporter. I think he's taking a nap now. He's been up all night. And he said, Annmarie, name me a state, I'll find you pork. They're all getting something to get their vote.
Bond yields are lower this morning. We're down by about 2 or 3 basis points at the moment, a break of 420 in the last 24 hours. Up next on the programme, in the third hour of Bloomberg Surveillance, we'll catch up with Cameron Dawson of NewEdge Wealth, Clay Griffin of MoffettNathanson, Blerina Uruci of T.Rowe Price, and Collin Martin of Charles Schwab. Live from New York City, the second half of 2025 officially begins. This is Bloomberg.
We've seen an economy that's beginning to slow. It's being hit by policy changes that businesses are trying to digest.
There's probably a bit of a back and forth and on the data front.
We're not actually making progress on inflation.
If the unemployment deteriorates, I think the Fed will react to that.
The markets, I think, are still looking for a smoking gun. To me, that could be a negative payroll print.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, as does the second half of 2025, coming into Q3 at all-time highs and pulling back just a little bit on the S&P. We're down a few tenths of 1% across the board here, down a third on the Nasdaq 100. The attention for all of us right now is on the Senate as they look to pass the one big beautiful bill. The president speaking just moments ago, Annmarie saying the tax bill will hopefully pass today.
He's seeing some good momentum when he's hearing about. He says we think we're going to get there when it comes to this bill. They are still debating it. We are still waiting on a number of amendments. One critical amendment from Joni Ernst when it comes to what is going on with solar and wind renewable subsidies that potentially could get more moderates on board. The individual I'm looking out for, yes, the vice president is there, so maybe we're close. But the individual I'm looking out for is one holdout when it comes to Senator Lisa Murkowski of Alaska. They've been trying to work out a carve-out for Medicaid funds in her state of Alaska. If they're able to get that language over the finish line, she could be a yes, and this can go back to the lower chamber.
The individual I'm looking out for is Elon Musk. The stock I'm looking at right now is Tesla, near session lows and down by more than 5%. The president on Elon Musk just moments ago asked about deporting the CEO of Tesla, saying we'll have to take a look.
This coming after his tweet fest or truth fest over the past 24 hours, talking about how this one South African can come in here and has gotten so many subsidies that Doge should really take a look at all of the potential benefits that Tesla has received and Elon Musk's companies has received from the United States government. I just want to take a step back and show how quickly things can change for specific companies, for specific policies, and it raises the question, yes, we seem like we're stable when you just look at the gains in the S&P 500, but what this type of volatility does for the dollar going forward, as well as potentially individual names.
Rhetoric is very hot when you have the President of the United States saying he's going to look into deporting an individual. What I would say, though, is something that Craig Trudell said earlier. Elon Musk has been super consistent when it comes to subsidies. He's like, if they're not going to be for my industry, they shouldn't be for any industry. Why do we also have subsidies for the oil and gas industry if we're not going to also have them for the EV industry? He's been against them writ large across the board, because now Republicans are saying the only reason he's coming out is because of the EV subsidies, which, to their point, they have been campaigning on for over a year.
It's also fair to say they've been consistent too, to your point. That stock is down by more than 5%. A theme of the program this morning, the president taking on Elon Musk, taking on holdout Republicans, also taking on Chairman Powell. Later on this morning, in about 90 minutes from now, call it 87, Chairman Powell sitting down in Sintra, Portugal with some of his peers, working out the path forward for monetary policy.
Do you think he's going to write a handwritten note with a Sharpie?
Should ask him, did he return?
Inflation? Did he return it? Yeah, and hold it up saying, I am in wait and see mode. You know, at a certain point, you have to wonder what new can he say. We have heard that he does seem open to September for a rate cut, which is the de facto pricing in markets. We've heard from other Fed officials. So how far is he away from what the Fed wants? Well, the Fed, from what President Trump wants? Well, President Trump wants a 1% Fed funds rate, which he is not going to get. And if he does get, good luck to long-end treasuries.
To John's point yesterday, maybe Jay Powell needs to turn around and say, set your tariff rate, and then I could set a new interest rate. To the point that he had on the hearing was not just the impact of the tariffs, but what are the tariffs going to be? We're talking about the one big beautiful bill this morning because they have this self-imposed deadline of July 4th. Next week, it is all trade.
Print out the statement, get a Sharpie and sign it. JP? Something like that.
Yeah, I could just imagine that. You know, you don't want him, you don't want President Trump saying deport Jay Powell. I mean, honestly, how much more do you need these catfights to really get?
We want it to settle down.
Yeah, I think so.
For market participants, they couldn't care less. We've talked about this a million times. All-time highs on the S&P 500. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth, following the S&P's best quarter since 23. Clay Griffin of MoffettNathanson as Apple looks beyond Cupertino for solutions, and Blerina Uruci of T.Rowe Price as President Trump ramps up the pressure on the Federal Reserve. We begin this hour with stocks taking a breather after posting fresh record highs. Cameron Dawson of NewEdge Wealth writing, we still see the equity pain trade being higher thanks to relatively light positioning, which creates the potential for a continued chasing of strength. Cameron joins us now for more. Cameron, good morning.
Good morning.
Pain trade's higher. Does it come with narrow leadership too?
I think it does simply because we're seeing narrow leadership within the earnings line. Because earnings revisions higher are really being driven by Mag 7 and growth names, it suggests that you continue to see this narrow leadership, and you see it in the equal weight S&P 500 making a new relative low versus the market, not just this year, but actually undercutting the December low. So yes, there's broad participation in the market. There's 72% of names are above their 50-day moving average, but the magnitude of the upside is just in a handful of names.
You talked about the E, the earnings revisions improving for that cohort of stocks. What about the P? What's the price of the story now?
It is times like this that we have to remember that valuation is not a good timing tool, and that there are occasionally short-term periods that cause valuations to defy gravity. We think that we could be in one of those short-term periods because sentiment is not stretched. There are still more bears than bulls in the AI Bull Bear Index, and positioning is still light. 20th percentile in that Deutsche Bank consolidated positioning. That can cause a chase into markets. We are already trading at 22.1 times forward, so you have a scenario where if you get that chase, further multiple expansion, earnings maybe stay stable, that's when we're looking out in the next couple of months, you could see more volatility. But near term, you get the chase.
So if you see things as expensive, but potentially likely to go more expensive, what do you do with that?
Yeah, we think that we have to stay up in the quality sphere. You have seen a huge rally in low quality, high beta names. So if you look at the lowest quality parts of the market, it's had more than double the return than the rest of the market. That's not something we want to chase, because what you're inviting, if you chase that, is a lot more downside volatility when eventually the valuation hits a ceiling. So we stick to high quality, we stick to our knitting, looking for very small pockets at this point of relative value. Hard to find, but I think that remains very important.
If Bob Michael is correct, and the bond vigilantes never existed, and the horseback riders just, have basically retired, at what point do you see lower yields ahead on the heels of lower inflation and a Fed that is geared up to cut, potentially acting as a tailwind to multiple expansion?
This is always the danger with ascribing narrative to price action. Because when we looked at bond yields rising, we said it must be deficits that are causing bond yields to rise. In fact, what we saw instead, like going back into the fall of last year, it was economic surprises soaring higher. So you've seen economic surprises turn much lower. People have been cutting their GDP growth estimates. Those have started to tick back higher. But I think that that's the core reason why we've seen this move in bond yields lower. So it all depends on the backdrop of the data in order to tell us where we think that the bond market will go.
I want to talk to you about policy because they're debating this bill. You say never has so little cost so much. Yeah. Is this going to be stimulative at all for the economy?
We think very minimally. It's so different than 2017, where people were seeing a big step change function difference in individual tax rates as well as the corporate tax rate. And you go back to that time, you had a big uplift in the earnings line for corporate taxes for the S&P 500 in being able to drive that upside in EPS growth. This bill, you don't get any of that. We would consider things like accelerated depreciation being just a continuation of prior policy. You're seeing the continuation of prior policy on individual taxes. So on a net basis, this doesn't do much, and yet it costs so much.
So it's basically just an extension of policy, which we've been talking about for months. Yeah. What would be stimulative to this economy right now?
Yeah, well, the question is, how much has the industrial policy that you saw over the last couple of years been stimulative? And those are the things that you're actually starting to walk back with the walking back of some of the IRA provisions. All you have to do is look at non-residential construction structures of manufacturing. They have skyrocketed over the past couple of years because of that industrial policy, and that's the exact thing that they're starting to walk back from.
Payrolls Thursday. Is bad news good news?
Yeah, that's a big open question. I think bad news is good news for the bond market, but it remains to be seen for the equity market. Because if it is such bad news that we start looking at the labor market data and saying, ooh, this could be much weaker than expected, we need to cut GDP growth forecasts, we need to cut earnings growth forecasts, that's when bad news is bad news for equities. But if it's just a little bit lighter, then equities likely rally on this hope that maybe we get rate cuts sooner.
Mike Wilson of Morgan Stanley had this to say: the equity market isn't going to wait for the obvious signal in terms of a more dovish shift in monetary policy from the Fed. Stocks will get in front of it.
And that's really the bet for a lot of the bulls, is that any kind of weakness will be met with cutting and then some, and some sort of Fed response, policy response that will give some sort of further fuel to an equity market that hasn't even been trading on economic fundamentals.
I'm sure you saw Hatzius yesterday and the team over at Goldman bringing forward the call for the Federal Reserve to September now. That's their first cut call for this year.
Yeah, and that's pulling it up a month. And the reason why is because they do believe that there is going to be this weakness, but also because Fed officials are telling us. They're saying we're open for September. We need a couple of months, and that's what they're going to get by the time September rolls around.
Payrolls a few days away. The estimate in our survey, 110K. Later on this morning, look out for jobs. Look out for JOLTS, job openings. That's going to be important. I know it's a little bit dated, but just following that low churn story that you described earlier in the programme, just how frozen is this labour market?
I'm really concerned about it. I have to be honest, especially for college graduates, and not just because I have children who are getting toward that age in any way, shape, or form. But, you just wonder if the market is less dynamic, do people have less confidence that if they lose their job, they can go out and find something else? Do they have less confidence that they can keep spending at the rate that Americans like to traditionally spend? It just calls into question some of the economic models of the United States.
You certainly see that in the labour differential of the Conference Board Consumer Confidence Survey, that's for sure. Cameron, appreciate this. It's good to see you. Thank you. Cameron Dawson there of NewEdge Wealth, looking for higher equity markets and narrower leadership. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Senate Republican leaders are looking for votes to pass President Trump's $3.3 trillion tax and spending bill. They've been up all night and are continuing to vote on amendments to the legislation. Vice President J.D. Vance is now at the Capitol. He would cast a tie-breaking vote if needed to get the bill over the finish line. Meanwhile, Israeli Prime Minister Benjamin Netanyahu says he'll travel to Washington next week. According to a statement from his office, he plans to meet with President Trump, Vice President J.D. Vance, and Commerce Secretary Howard Lutnick as he looks to reach a deal on trade. Netanyahu is also expected to speak to the president about negotiating a truce to end the war with Gaza. And China's largest coffee chain touched down in the U.S. Luckin Coffee opened its first U.S. location in New York City yesterday. The chain surpassed Starbucks to become the biggest coffee retailer in China back in 2023. To celebrate its debut, customers who use the app can get their first drink for $1.99. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later in the hour. Up next, the morning calls. Plus, Clay Griffin of Moffett-Nathanson as Apple looks beyond Cupertino for help on AI. From New York, this is Bloomberg. Live from New York City this morning. Good morning. Attention on Washington, D.C., the President of the United States.
And I hear it's going okay. We'll move it along. But we'll be back here pretty early.
What do you think the president on the bill used in warning some Republicans not to go too crazy with the cuts? Are there parts of the bill or amendments that you think cut too much?
We're going to have to see the final version. I don't want to go too crazy with cuts. I don't like cuts. There are certain things that have been cut, which is good. I think we're doing well. We're going to have to see. It's very complicated stuff. Great enthusiasm, as you know. And I think in the end, we're going to have it. What do you think, Caroline? Yeah, I think.
What do you think about Zoran Mamdani having such a hard time condemning the phrase globalizing intifada?
I think he's terrible. He's a communist. The last thing we need is a communist. I said there will never be socialism in the United States. Now we have a communist. So I think he's bad news. And I think we're going to have a lot of fun with him, watching him, because he has to come right to this building to get his money. And don't worry, he's not going to run away with anything. I think he's, frankly, I've heard he's a total nut job. I think the people of New York are crazy. If they go this route, I think they're crazy. We will have a communist for the first time, really, a pure, true communist. He wants to operate the grocery stores, the department stores. What about the people that are there? I think it's crazy.
What happened to Elon Musk?
Who?
What happened to Elon Musk?
Nothing. He's upset that he's losing his EV mandate, and he's very upset about things, but You know, he could lose a lot more than that. I can tell you right now. Hey, Elon can lose a lot more than that. We hope it's going to happen, and we're looking forward to happen sometime next week. We want to get our hostages back. We want to get the hostages back.
What if the big beautiful bill doesn't pass? You have to go through item by item by item and pass this stuff one at a time, or are you just going to try again?
I think we're going to get there. It's tough. We're trying to break it down so it's really good for the country. Trying to get a lot for everybody. And it's a big bill. And smaller bills would have been easy, but they wouldn't have been as good. I think it's going to do okay.
And with the alligator Alcatraz, is the idea that if some illegal immigrant escapes, they just get eaten by an alligator or a snake or something?
I guess that's the concept. This is not a nice business. I guess that's the concept. If snakes are fast, but alligators are, but we're going to teach them how to run away from an alligator, okay? If they escape prison, how to run away. Don't run in a straight line. Run like this. And you know what? Your chances go up about 1%. Okay? Not a good thing.
What are you going to talk to Netanyahu about next Monday?
Well, he's coming here. We're going to talk about a lot of things. We're going to talk about the great success we had. I mean, we had an incredible, in Iran, we had an incredible success. Like really nobody's had in many, many years. That was a precision war strike, and the word obliteration can now be used because the Atomic Energy Commission said you can't even get into the place. It was demolished. It was really demolished. It was a great, brilliant strike, and how to go forward. We're also going to talk about Gaza. We want to get the rest. We got a lot of hostages back, but we're going to talk about Gaza. I don't know. I think we'll have to take a look. We might have to put Doge on Elon. You know what Doge is? Doge is the monster that might have to go back and eat Elon. Wouldn't that be terrible? He gets a lot of subsidies, Peter. But Elon's very upset that the EV mandate is going to be terminated. And you know what? When you look at it, not everybody wants an electric car. I don't want an electric car. I want to have maybe gasoline, maybe electric, maybe a hybrid, maybe someday a hydrogen. If you have a hydrogen car, it has one problem. It blows up, So I'm going to give that one to Peter. I'm going to let Peter test it out. The hydrogen cars, and when they blow up, it's serious. They find you 5 blocks away. It's not good.
How are the trade talks going? Are there any countries we can expect to see before the July 9th deadline?
Everything's going well. Honestly, everything. This is very complicated because it's very big, a lot of different areas. Look, the Republicans have their heart in it. The Democrats they just want to destroy our country. A Democrat wants to destroy the country. They won't vote on it. They don't vote on anything. This is the biggest tax cut in history. Everything is the biggest in history. It's the best bill we've ever had. We can't get one Democrat vote.
When do you think you'll get final? When do you think you'll get final?
Nice guy, Peter. What do you think?
Very nice guy. When do you think you'll get final passage of the bill?
Hopefully soon. Hopefully today, if we can. Final passage. When I say final is let's take Senate at a time, okay? But I think Senate could be today, and we go over to the House.
And what about Senator Murkowski? Is there any way to placate her?
Who knows? You tell me. You tell me. Is there? Alaska's done so well with me. There's never been a president better to Alaska than me. But it doesn't mean people appreciate it. Have a good time.
The President of the United States there, just speaking outside of the White House, departing just moments ago with some comments on a number of issues. We'll pick out two. One on the tax bill. The tax bill will hopefully pass today. The other on Elon Musk. Some really punchy language on the Tesla CEO, captured by the stock this morning. That name is down and down hard in the pre-market. On the West Coast, joining us now is Bloomberg's Ed Ludlow. Ed, some renewed tension between the President of the United States and Elon Musk.
Yeah, the Trump trade can go both ways, right? We talked about the Trump trade in November ahead of the election result being a sort of boon to Tesla stock. And now in the session, the stock has held its declines at I think, down 6% in the pre-market. Basically, I'd reiterate the president was asked the question, would you look at deporting Elon Musk? And the president answered in the affirmative that he would have to look at it. I find this difficult to report on and follow, John. I mean, Elon has talked in interviews. It was referred to in Walter Isaacson's 2023 biography that Musk had taken the oath of citizenship in 2002 in Los Angeles County at the fairgrounds. So he's a US citizen. So that's the kind of volatility of the relationship that's weighing on the stock. The EV and incentives part of the big, beautiful bill, it seems disconnected and separate. And on that point, at least, Elon Musk has been a lot more consistent. Elon Musk has said and maintained for some time that he'd be fine if they did away with those direct consumer incentives, because he's felt that Tesla has a competitive cost base, it has pricing power, and it would be a great advantage to Tesla over other American automakers if those incentives went away. Obviously, the president's statements, not just this morning, but in prior weeks and months, would contradict that.
Well, Elon Musk is saying that they should go, if they go away for the EV companies, they should go away for other parts of energy like the oil and gas world as well. The rhetoric is obviously very hot when you hear the president talking about and responding to this question of deportation. He said Doge is the monster that might have to go back and eat Elon. What else could the U.S. government do to hurt Elon Musk or one of his companies?
Well, if you remember the Thursday and Friday where the war of words took place on X, between the president and Elon Musk, what we tried to do was calculate the exposure that Elon Inc. has to federal contracts, right? Because that was the threat put in place by the president. And, you know, on the Tesla side, that's more insulated. There is some element of incentive or government subsidy beyond direct consumer incentives. That largely has supported Tesla in its manufacturing base. On SpaceX, a big chunk of SpaceX's revenue is contracts with the Department of Defense, with NASA, the space agency. So there's exposure there. But again, like I kind of bring this back to DCAMH and the big, beautiful bill. Elon Musk is often inconsistent, but on these issues, he would argue he has been consistent. He's very worried about the national debt. And in the campaign, when Elon Musk went on the road for the president, he said, and he has said since, I supported you in the idea that you would address this issue. And he, you know, clearly has an ideological point of difference with the president. And I see some headlines from the Treasury Secretary as well on the idea of how this bill addresses that national debt pile.
Yeah, I think his line this morning was stick to rockets and I'll do the finance. Ed, thank you, sir.
Sure.
Ed Ludlow, thank you, on the West Coast. More with Ed on Bloomberg Technology at 11 a.m. Eastern Time, no doubt following this story. If you speak to the analysts on this story, they'll tell you this is what we expected. But it's the mood music around the stock that's driving this name lower this morning, and the mood music not great this morning. We're down by close to 6% in the pre-market. Up next, we'll catch up with Blerina Uruci of T. Rowe Price as President Trump sends a message to Fed Chair Jay Powell, plus Danny Berger with your morning movers with more on Tesla. Live from New York, this is Bloomberg. The opening about 60 minutes away. Equity futures negative by 0.4%. Net session lows at the moment on the S&P, following a really decent run of gains on the S&P 500. Back-to-back all-time highs coming into Q3. With 60 minutes until that opening bell, let's get you some morning movers and cross over to Danny Berger for more. Hey, Danny.
Hey, John. The pain is not letting up for Tesla. Looks like it's at a new low for the morning, down nearly 6%. You were just speaking with Ed Ludlow about this. And we heard from the president moments ago, re-upping this threat, saying maybe we should have Doge look at Elon Musk's company. Underlying all this, and Trump took to Truth Social also to make a similar type of threat, let's call it, to remove some of the subsidies for Elon Musk's businesses after he criticized the tax bill. So those shares, again, down nearly 6%. Also falling in the pre-market this morning, Warner Brothers Discovery, those shares down nearly 5%. According to people familiar, the Advanced Newhouse publishing house, also controlled by the billionaire Newhouse family, will be selling about a $1.1 million stake in Warner Brothers Discovery. We don't have the reason why behind it. We know that this is a company that will be engaged in a breakup, but Newhouse is the second biggest shareholder, owns about 8% of the company. Finally, wrapping things up with a move to the upside this morning. The big casinos doing really well here in the pre-market. Las Vegas Sands up 5.7%, Wynn Resorts up 5%. We got some numbers from Macau of revenue figures, those coming in 19% for the month of June year over year. The estimate was for just 9%. So gambling alive and well in that region. It makes up about half of the revenue of these companies. So improving this morning, John.
Danny, appreciate the update. Danny, thank you. A few of the names to look for going into the opening bell about 60 minutes from now. Also looking ahead to Fed Chair Jay Powell speaking in about 60 minutes' time. Let's turn to the Fed as the president continues his criticism of the Fed chair.
The president sent this note to the Fed chair. It says, Jerome, you are as usual too late. You have cost the USA a fortune and continue to do so. You should lower the rate by a lot. Hundreds of billions of dollars are being lost, and there is no inflation.
Joining us now to discuss is Bloomberg's Mike McKee. Mike, good morning. The chairman gets an opportunity to counter that later.
I suspect he will not jump at that opportunity, although I'm sure it will be offered. The question is, what does he really say? Now, if he wanted to make an argument against what the president's press secretary was saying and what that note said, it would be very easy to do so, courtesy of this chart, which John Authors produced today for his Bloomberg newsletter. You've got here the Fed funds rate and the 10-year yield. The government's debt load is based on the longer end of the curve, not the shorter end of the curve. But look what happens when the Fed cuts the short end of the curve. Since September of last year, the 10-year note yield has only gone up. So lowering the rate didn't do anything to save the government any money, and probably would not do so. As many bond strategists have told you, we are likely to see a curve steepening ahead. Now, what does he say at Sintra, and what do the others say? Well, they've all got their own problems, so it might be more of a group therapy session. But I want to point out this quote from Jay Powell. We're getting a gradually cooling economy, a gradually cooling labor market, progress on inflation, 4% unemployment, 2% growth. We're kind of getting what we want to have. Well, that was him 1 year ago at Sintra. The situation seems to have not changed at all in terms of the economic conditions, but boy, the outlook sure has changed. So what does he say?
And Mike McKee, he says the economy right now is solid. Does the data actually speak to that?
No, well, the data suggests that the economy has been to this point relatively solid, but the soft data suggests that things are starting to slow down. We have seen a rise in jobless claims. We're forecast to see real slowing in job growth on Thursday. And we are looking at ISM numbers coming out today and on Wednesday that would suggest as well that things are slowing down. The question is it slow or is it a fall?
Mike McKee, appreciate it. Mike, thank you, sir. Or as Lisa, you've said continuously, cool versus cooling, weak versus weakening. Two very different things.
At a time when you can expect the actual number to be a lot lower, what do you do with just a completely stagnant labor market? Is this acceptable for an economy that has come to rely on that kind of churn? That, I think, is going to be a deeper question and one the Fed's going to talk about more, I'm sure, at Jackson Hole.
Joining us now to talk about it right now is Blerina Uruci of T.Rowe Price. Blerina, let's talk about it. The low churn dynamic that Lisa just gave a nod to. How much longer can we stick in that kind of situation, that kind of dynamic?
It's a very interesting dynamic for the U.S. economy right now. When you look at the flow of data up to date, you really see the labor market has loosened a lot, and that's come at the back of slowing demand for workers. I am not too concerned. We're not seeing a big pickup in the unemployment rate, but it does tell you that if the Fed were to base monetary policy purely on the progress made on inflation so far and the cooling in the labor market, I think they would be much more comfortable signaling cutting interest rates later this year. But the key here was what Mike McKee was alluding to earlier, that the outlook has changed so much, and most of the risks point to upside to inflation. And so the Fed has come so far, I think they're very reluctant to undo all the progress we've made and cut prematurely. And again, what matters for the economy and for the long end of the curve is if monetary policy is appropriately set or not. And we saw that in last September when the Fed cut interest rates by 50 basis points, but the long end went higher. And that was basically telling the Fed that, wait a minute, the economy is resilient. Why are we cutting interest rates? I think this is not setting us up for success for the risks going ahead. And I think the Fed wants to avoid that situation this year.
There's been a tone shift, though, and John alluded to it when he started talking about the Goldman Sachs note that came out, Jan Hatzius and the team, that brought forward rate cuts and see a greater number of them this year. Fed members themselves are saying it looks as though the inflation impact from the tariffs will be more of a one-time shock than they will some sort of protracted inflationary impulse. And you aren't seeing any kind of inflationary read-through from the labor market that is cooling, if not maybe even showing signs of cracks. Are you also coming around to that kind of a conclusion where it seems to make sense for the Fed to cut more and sooner?
So my baseline for the Fed this year is 2 cuts, 2 25 basis point cuts starting in September. I think the market has fluctuated between 1.5 to 3 cuts at different points of the year. The question is, can the Fed bring forward interest rate cuts to the July meeting? I think that's something that the market is not really prepared for. I don't think we have enough time to see a deterioration in the data that would push the Fed in that direction. So then what would make the Fed and the market price, let's say 3 or 4 cuts for this year? I think we would need to see a pretty big increase in the unemployment rate. Otherwise, even though the labor market is not a source of inflation right now, if you have a 1 or 2 time shock to inflation, even though it's not supposed to be persistent, it can de-anchor inflation expectations. So I'm looking at the unemployment rate here because that's the only way that you get the labor market to push the Fed off the fence. And when I'm thinking about the unemployment rate, there are 2 components that matter. One is labor demand and hiring and firing. I think labor demand has cooled significantly, but we're not seeing mass firing yet. And then I also think the break-even rate of employment has come down a lot. The break-even rate of employment is that which keeps the unemployment rate steady. It doesn't go up, it doesn't go lower. It's come down a lot because net migrant flows have decelerated in the last 12 months or so. And so with weaker labor supply, it's much harder to get the unemployment rate to increase a lot unless you have mass firing. So I think we're here at an uneasy equilibrium. And so for me, it makes a lot of sense for the Fed to tread carefully. So I feel comfortable with keeping 2 interest rate cuts in my outlook for this year.
What's the potential for upside surprises later in the year, particularly once the One Big Beautiful Bill has passed and once people have more certainty around what the tariff outlook looks like?
So in terms of inflation upside surprises, I see 2 pivotal moments. In the next 2 to 3 CPI reports, I'm looking for signs that we're getting significant pass-through to consumer prices from higher tariffs. What we see so far is import prices have not budged. So that's telling me that exporters into the U.S. are not adjusting prices. So then that leaves domestic firms and consumers as the agents that are going to bear the brunt of the tariff increases. We also have a weaker dollar, so the currency is not helping us on the inflation front. So I'm looking at the CPI reports for upside risks, and that's the one-off shock that everybody's talking about. But then we have the One Big Beautiful Bill. I think there is a real chance that this stimulates demand in the near term. So then the next risk that I see to inflation is in 2026 from fiscal policy. I think we learned our lessons from the supply chain disruptions and from the fiscal bill post-COVID that they can push inflation higher. I don't think the size of the shocks right now is as big as it was back then, but I do think it's realistic to expect some upside to inflation.
Looking ahead to lots of data this week. Payroll's very much in focus. Blerina Uruci of T.Rowe Price, and I think my microphone has just...
Yeah, so I think that Blerina Uruci of T.Rowe Price, thank you so much. Right now, John will get his mic all set up, and let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Let's start with Tesla shares. They are down nearly 6% after President Trump took aim at Elon Musk over EV subsidies, posting on Truth Social that the Tesla CEO might, quote, get more subsidy than any human being in history. Just earlier, Trump also said he would look into deporting Musk, who was born in South Africa but holds U.S. citizenship. Meanwhile, President Trump is heading to Ocho-P, Florida to visit the Dade Collier Training and Transition Airport, now known as Alligator Alcatraz. It's a new 1,000-bed detention center being built in the isolated Everglades airfield west of Miami. Trump will take a tour of the facility and then hold a roundtable with local officials. And the pass rate for the second level of the CFA test soared well above the decade average in May, according to a statement from the CFA Institute. 54% of candidates passed, up from a 39% success rate for those who took the test back in November. The May results are higher than the 10-year average of 45% and the second highest since 2020. That's your brief.
We fixed that, Yahira. Thank you. Don't use rechargeable batteries. They're no good. That's the lesson from this morning.
Is this like an electric vehicle commentary?
That is exactly the comparison.
Oh, yeah?
Why are we using rechargeable batteries here at Bloomberg?
You have range anxiety? Is that sort of similar?
Well, something like that. We'll have that conversation in the commercial break. It'll be a good one. Up next on the programme, we're setting you up for the day ahead, plus Collin Martin and Charles Schwab as investors await remarks from Fed Chair Jay Powell. Equities negative this morning. We're down by about 1/3% as we kick off Q3 in the second half of 25. We're down 0.5% on the Nasdaq 100. The single name to watch this morning is Tesla. The spat between Elon Musk and the president ramping up once again. Tesla down through most of this morning by something like 4, 5, 6%. As we count you down to the opening bell, a few things to look forward to through the rest of this week. At 9:30 Eastern Time, Fed Chair Jay Powell and ECB President Christine Lagarde speaking at the ECB Forum in Sintra, Portugal. At 10 a.m, ISM manufacturing and jolts data. Wednesday, the ADP employment report. On Thursday, US trade balance and another round of jobless claims, plus the big one, the payrolls report. And then before we get to the weekend, we're hoping to pass that tax bill down in Washington, D.C. Joining us now to talk about it, Bloomberg's Tyler Kendall in the nation's capital. Tyler, what's the latest?
Yeah, hey, John. Well, we heard from President Trump a short time ago saying that he thinks they're on track for the Senate to pass this by today. But at the moment, they still don't have the votes. As Senate Majority Leader John Thune, our reporters on the Hill tell us, is convening with some of those key holdouts to try to strike some sort of deals here in order to get this done. We know the White House is going to be laying on the pressure. An administration official tells us that President Trump has been in contact with lawmakers, and they've already deployed Vice President J.D. Vance to the Hill, who would be there poised and ready to cast a tie-breaking vote if it does come to that. Now, it was interesting to hear that President Trump was asked specifically about one holdout, Senator Lisa Murkowski, whether or not he knew what it would take to get her over the finish line. He said that he didn't, but I can tell you that we're closely watching one key amendment that hasn't come up for a vote yet, but would likely pass. It's looking like it's getting momentum to pass, and it would likely get Lisa Murkowski on board because it would be more lenient with the phase out of clean energy tax credits. While that amendment hasn't come up yet, John, we can say that the Votorama has officially broken a record. It is the most amendments ever introduced in a Votorama. We are currently on amendment number 45.
You're watching Senator Murkowski and you're still counting. We're all watching Elon Musk and a stock that's still dropping. Tyler, this tension, where's it come from this time around? Because this was widely expected. The president campaigned on this very issue.
Right, and that was the point that President Trump himself made in his post on Truth Social yesterday, saying that he has been open with Elon Musk, that he has long taken issue with the clean energy tax credits under the Inflation Reduction Act. Now, President Trump himself said that he thinks that this was spurred by the EV mandate. But in his words, he thinks that Musk has a lot more to lose than that. And he actually threatened the government subsidies that Musk's company receives as being potentially on the chopping block, saying, quote, Doge is the monster that might have to go back and eat Elon. We're going to have to see how this actually shakes out here, because we know that it's pitting Republicans between President Trump and the biggest U.S. political donor in the 2024 cycle.
Tyler, thank you. Some real tension. Don't see it in this bond market, though. Tyler Kendall, thank you. Yields are lower by just a single basis point. The 10-year still around 4.20. Let's turn to the bond market and the Federal Reserve. Collin Martin of the Schwab Center for Financial Research writing, expectations for the number of Fed rate cuts this year continues to increase despite the relatively stable labour market. Collin joins us now for more. Collin, good morning.
Good morning.
Can you explain that then? Why is that happening?
Well, I think it has to do with the idea that inflation actually continues to move lower despite the fact that tariffs are in place. If we take away the tariffs, which we can't do, of course, but absent the tariffs, the Fed probably would have cut already. And if we look at what's going on in the inflation data right now, we're still seeing that dichotomy between services and goods. And we are seeing a slight pickup in the goods inflation, specifically things coming in from China. But we're seeing a lot of disinflation or maybe even deflation on the services side. So the inflation data suggests that they could be cutting absent those tariffs. But the labor market's still holding up. I mean, maybe that starts to change soon. But what I think is really remarkable is if you look at that unemployment rate, 4.4% to 4.2%, that very narrow range for 13 straight months. It's expected to increase a little bit when we get the report on Thursday. But if it doesn't, if it's 4.2, that's 14 straight months. The labor market's holding in. We're seeing, the low hiring, low firing, but that's okay for the economy to kind of continue to chug along right now. So that's doing okay. I think the concerns in the second half of the year, now that it is July, is what happens next. And will we start to see the weakness in that labor market, given that the tariffs have to have an impact somewhere? If they're not passed along to the consumer, does that impact margins, which therefore might impact the labor market? So right now, we're kind of stuck between the rock and a hard place. But all signs are suggesting we get rate cuts later this year.
If we rewind to April 2nd, the narrative was that tariffs will cause the inflation rate to surge and deficits will ignite bond vigilantes with their pitchforks to never buy U.S. bonds ever again. Are we saying both of those things are not true?
Well, on the tariff front, that's the confusing part right now. If you look at Fed expectations, even though there is kind of some vocal members who think we can be cutting soon, if you look and dive into the Fed projections, the median projections suggest inflation should increase. And even if you look at that range, the lowest expected inflation, core inflation rate by the end of the year is still 2.5%. So there's still an expectation that it should increase prices. We just haven't seen it yet. So there's this idea that maybe people imported goods, early in advance of this. They haven't chosen to pass it through. We think there has to be some sort of impact at some point. Of course, not the full effect of the tariffs, but some of it should get passed along, especially when you add in the fact that the dollar's declined. So you have that working against you as well. On the bond vigilantes, they don't care right now. We've long held that debts and deficits are not a key driver of the direction of long-term interest rates. We've always focused on monetary policy and growth and inflation expectations. We dialed that back a little bit recently just because our debt continues to grow. And there doesn't appear to be any interest in Washington to fix the situation.
Okay, hold on a second. I'm sorry to jump in here. So deficits don't matter. People could just keep on printing money until a point, and then they do matter. We've been talking about this all year. When do they matter? I mean, it's expanding right now, and no one seems to care. Bond yields are actually lower on the day.
Yeah, we don't have the number for when it matters because there just hasn't been the relationship. So how we've been framing it is because we get this concern from our clients at Schwab all the time. We hear about it, especially with everything going on in Washington. Is this going to send long-term yields significantly higher? And we say they're not. We don't expect the 10-year to get to 6, 7, 8% anytime soon. What we have thought, and which actually hasn't been the case over the past handful of days, is that maybe it keeps them elevated. We thought maybe the 10-year goes to that 5% range, or maybe hovers between 4.5% to 5%. So instead of falling in line with potential rate cuts later this year, maybe the fact that debt needs to continue to rise, we need to attract new buyers to buy those, maybe that just kind of keeps them where they are. But that's been proven wrong over the past couple of days as well.
Would the bond market push back on a Fed chair that they don't see as credible? An extension of Trump, an extension of the White House?
You know, we've been talking about that a lot. What happens if we get what the administration's been hinting that they could do in terms of, you know, shifting their issuance from coupons to T-bills or a huge drop in the Fed funds rate? I mean, we've heard things from 200 basis points to 350 basis points. That would pull short-term rates a lot lower, I would think. But I think that could weigh on the long end. We might see long-term yields fall initially just based on that supply-demand imbalance.
But I'm not talking about what the new Fed chair might do next year. I'm talking about the fact that is this person seen as credible to the institution?
Yeah, that concerns us. We worry about a lack of Fed independence. And we know that can have bad impacts if the Fed chair and the committee as a whole are doing things that are more based on short-term goals that the administration wants versus what their dual mandate suggests, price stability and maximum employment. We do worry that that can have an effect on the Treasury market, specifically long-term Treasuries. The dollar market, we could see the dollar continue to decline if that were to happen. So that is a worry of ours, and it could send long-term yields a little bit higher.
Haven't they totally and utterly failed to hit the price stability side of their dual mandate for the last several years?
They have. We're moving in the right direction, though.
Directionally, yes. But isn't that the ultimate criticism of them and this Fed chair? I know that he's celebrated a lot on Wall Street and by economists that work on Wall Street, but ultimately he's fallen short, or rather fallen above, where he should be for a long, long time now. And if you go back a few years ago when he delivered that speech at Jackson Hole, 8 minutes of pain, then there wasn't any pain and everyone celebrated. Not sure why they celebrated. Inflation never went back down to target. It was never mission accomplished, was it?
Yeah. Well, technically, no. You're right. Definitionally, we have not gotten 2%. If anything, though, that calls for the rate to stay where it is or arguably higher. And that's, I think, where you get the lack of confidence in the market, because you're right. We're not at that 2% goal yet. They're projecting it to continue to move higher at the end of this year if the tariff, in fact, plays a role. And yet there are these calls for rate cuts. So, you know, it is tough. Totally. And I think if we were to get a new Fed chair, or just the committee as a whole, and they start cutting rates and we're still above target, I think that's a risk.
That's the ultimate issue, which is why the criticism, to your point, is kind of misplaced to this Federal Reserve. They cut rates 100 basis points last year. Rates went up at the long end, so did mortgage rates. That's the thing you need to get your teeth into. Bob Michael at JP Morgan was talking about the same thing earlier this morning.
And it might be the consequence of cutting, certainly as much as President Trump would like. It really goes to this question of how you trust data, because remember, last year the SOM rule was triggered and it was a head fake. And the Fed took that on its face and it cut rates significantly. And maybe in retrospect, the Fed chair doesn't think it was a mistake, but it raises a question: what data do you follow to understand that dual mandate when you're looking at inflation at a fuzzy moment and when you're looking at the labor market at a fuzzy moment?
The chairman of the Federal Reserve about 35 minutes away, alongside some of his peers, including the ECB President Christine Lagarde and the BOJ Governor Veda. Look out for that a little bit later. Colin Martin and Charles Schwab, thank you, sir. Good to see you, Collin. Appreciate it. Thank you. Coming up tomorrow, Brian Nick of NewEdge Wealth, Wei Lee of BlackRock, Sarah Hunt of Alpine Saxon Woods, and Jim Caron of Morgan Stanley from New York City. That does it for us this morning. Good morning to you all, and thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.